is raining down on the profit lines of America's biggest grocery stores and by extension putting downward pressure on their stock prices. Let's talk more about this with UBS senior retail analyst Michael Lasser, who covers the grocery store space. Michael, always great to see you. So when you talk to these management teams, what are they telling you about how they are dealing with inflationary pressures? And are there certain companies in your coverage that are doing a better job at managing this?
Well, good morning. Thank you very much for having me, Brian. When we talk to the management teams, what they're telling us is that they're trying to balance the needs of the business with the needs of consumers. But with that being said, they're passing along price increases at a faster clip than they ever have before because the pressures are coming from a wide variety of areas: raw material costs, oil, transportation costs. And so this is putting a lot of pressure on the budgets of consumers, particularly at the lower income end of the demographic spectrum. Who stands to benefit from this more than most are those retailers that are well positioned to help consumers save money. That's Costco, Walmart, the dollar stores. Those are all stocks that we would advocate owning at this level because they're well positioned for today and well positioned for the long run as well.
And Michael, what we've seen is that it's not even holistically Walmart as much as it is certain bulk categories within Walmart. Sam's Club, i.e., is what we saw in this most recent quarter. You mentioned Costco's. We also naturally think about BJ's as well. In kind of this flight to bulk, what does that tell you more broadly about consumer sentiment at this point in time, or even confidence in how far their dollar is going?
So consumers have to be more conscious of how far their dollar is going because the prices of essential items like food and energy are rising. In response to that, one of the trends we're seeing is trip consolidation and buying in larger quantities. It doesn't make sense to shop at as many stores, meander to as many retail locations because it'll cost the consumer more to do that. And that's helping the likes of Walmart, Sam's Club, Costco, and BJ's. At the same time, consumers are showing a proclivity to want to shop closer to home. So that's helping the retailers like Dollar General, Dollar Tree, and Family Dollar, who have convenient locations but also offer inexpensive goods. And that model looks particularly appealing in this environment.
But Michael, on the dollar stores, isn't this just the worst possible scenario for the likes of a Dollar Tree and a Dollar General, where they have the inflation in the goods coming onto the shelves, and then they have a consumer base that just doesn't have the income to handle those price increases?
So, Brian, I would actually think about it a little differently. Yes, that core lower income consumer that's typically well served by the dollar stores is facing a lot of pressure and has to allocate more of their total spend to these non-discretionary items. But at the same time, cohorts of consumers that are not at the lowest end of the spectrum, but are slightly higher than the lowest, are also having to trade down to the dollar stores in order to stretch their budgets. Dollar General might offer half a box of Cheerios, and if a consumer can't extend their budget for a full month and a full box of Cheerios, buy half a box to be able to put food on the table will look that much more appealing. So I think that value convenience spectrum that they offer is highly relevant in this market, both for today and for the longer term as well.
We do know that the Biden administration is planning to roll out $2.1 billion to really cater to the supply chain issues within food and in groceries specifically, and that coming in some prepared remarks from the U.S. Department of Agriculture. And so with that in mind, when do we believe that will actually make some sort of a dent in this broader system as well?
So I think the question of when will inflation start to abate is a big question. It's going to have many different factors that play into it. The consensus is that inflation will start to slow as we lap some of the bigger increases from last year. What's interesting from the retail reporting season is that a lot of the retailers said we have no choice but to continue to raise prices in the back half of the year. For example, Home Depot said that they expect prices to rise at a double-digit rate in the back half of the year. Walmart had indicated that it expects prices to continue to rise. And so despite lapping some pretty significant base effects from the prior year, based on the commentary of these retailers, it would seem to suggest that inflation and inflationary pressures are going to be here for at least the near term in some categories that are core to the consumer. So it's best to be mindful of this as you look out for at least the near term.
Michael, now you've covered Costco for a while. Do you think they're making a mistake by one, holding the line with not raising membership fees in this inflationary environment? How can they continue to sell $1.50 hot dogs with inflation where it is today?
Costco is a fantastic retailer. They've executed against this strategy for a long time. So we have confidence that they can continue to balance the needs of their customers and the needs of their shareholders. As far as the fee increase, our belief is that it's not a question of if, it's a question of when. And given that Costco generates about half of its operating income from its membership fees, this is an important conversation. But a shift back for raising its fees by 6 months is not going to have that dramatic of an impact on the share price. And if anything, raising the fees will provide a pool of savings that Costco can use to reinvest back into lower prices for its customers. As far as the hot dog, it's quite tasty. It's a great deal. And we expect that Costco will continue to only charge $1.50.
So true. Big fans. We're big fans of it here on the desk, Michael. Big fans.
I think the big question is,
you guys.
What's better, though, the IKEA meatballs or the Costco hot dog?
Costco hot dog and their rotisserie chicken.
That's a debate I'm not going to get into.
That's smart, Michael. That's smart. Michael Lasser, UBS Managing Director and Senior Research Analyst. Thanks so much for taking the time.
Let's get over to Matthew Lazzetti over at Deutsche Bank. Matthew, always good to see you here. So we've just been talking about the JOLTS report. Now, you were one of the first people on Wall Street to call recession amongst the biggest banks. Where are you at right now with that call?
Sure. First, thanks so much for having me. We've maintained that call. I think it's important to note that it was not for a near-term or imminent recession. The basis of our call was that we expected a recession towards the end of next year, in the second half of next year. And it was driven by a view that the labor market would remain remarkably tight, something that we're seeing with this morning's job openings data, quits rate data, and that inflationary pressures would be more persistent and ultimately force the Fed to be more aggressive in terms of the rate hike. So we still maintain that call. I think a lot of the data that we're seeing is suggestive of an economy that remains resilient, a labor market that remains tight, and a Fed that will need to tighten more aggressively than what the market currently anticipates.
But if we stay in this kind of recessionary period, because that's what it feels like. If you ask consumers, if you listen to businesses on their earnings calls, even if they are bullish about their business prospects, they are still very much monitoring the reality of a recession. And so with that in mind, if some of these elements remain intact through your target, which is second half of next year, that places us in a much different conversation by that point.
Yeah, certainly from a market perspective, there's been a lot of focus recently on recessionary risk, and that has been driven by the sharp tightening of financial conditions that we've seen, the sell-off in risk assets, most notably in equities. We've seen some alleviation of those pressures recently. What I would focus on from a real economy perspective is, what is the labor market telling us? And I think from that perspective, the best real-time indicator is jobless claims. And we've seen continuing claims remaining near record low levels, initial jobless claims remaining very low. It's suggestive of the labor market that we're not shedding labor because there is still substantial tightness there. And I think as long as that story holds in, you have consumer spending that will remain resilient, as we saw with last week's consumer spending data.
How long do you think it will stay intact, Matthew? Because you had President Biden come out in an op-ed this week in the Wall Street Journal, I think really reset expectations on job growth. Are we talking about later this year, we're getting, what, 50,000 jobs added each month?
Yeah, I think the context is really important. So over the past 3 months, we've added more than 500,000 jobs on average. And that's with an economy where the unemployment rate is already 3.6%, where you have 5.5 million more job openings than unemployed. So you have a really tight labor market at a time where we were seeing really, really strong job gains. Inevitably, that will slow. We think that you see 325,000 jobs later this week, and that will likely slow further as we go forward. But that is kind of the natural case of things as you get to a very tight labor market. The question will be, does labor demand hang in? Do job openings remain elevated? And does wage growth continue to pick up? And at least from that perspective, the data we saw this morning, I think, is still saying that it is a tight labor market. The quits rate remains elevated, and the wage growth should remain elevated at least over the next several quarters.
In the event that things reverse course, and perhaps because businesses are seeing more tightness in their balance sheet or their ability to actually maintain a profit over an extended period of time, whether that's because they're having more difficulty on the supply chain front or whether they're paying employees more and thus need to cut back on the number or the headcount that they have, those discharges, that comes even more into the conversation at that point. And so ultimately, where do you see those businesses netting out in, and at the end of the day, also some of the workers, and how they're going to be able to find those job opportunities if there aren't as many postings that are out there?
Yeah, that's currently the big macro debate at the moment. And we saw Governor Waller from the Fed devote a speech to this on Monday. What will happen as job openings come down? And given the huge buffer that we have of 5.5 million more job openings than unemployed, will unemployment ultimately begin to rise? Our view is that it will. That there's a lot of variation in these job openings relative to unemployed across different geographies and across different sectors. And so as the Fed tightens monetary policy, as financial conditions tighten, I think ultimately it will mean that the unemployment rate rises. And then historically, we know simply that once the unemployment rate rises by 0.5 or more, that has always coincided with a recession. And so that is essentially the basis of our call, that in order for inflation pressure to come down, the labor market has to loosen materially, and that the labor market loosening will likely mean the unemployment rate moving higher, and that has always been associated with a recession historically.
Gun Maverick is flying high after breaking box office records in its Memorial Day weekend opening, giving a positive outlook for the summer box office as blockbuster releases like Jurassic World Dominion and Thor Love and Thunder await their debuts. Joining us now to discuss is IMAX CEO Richard Gelfond. Richard, good to have you back on the show here. Do you think we're looking at a box office boom this summer?
I do think so, Brian. I think there's not much doubt about it. I mean, let's go back a few weeks, and Doctor Strange is now zeroing in on about $900 million in total gross. I think it'll get close to $1 billion. As you mentioned in your intro, Top Gun had a phenomenal opening weekend, close to $300 million globally. And then we looked at yesterday's results, which was a Tuesday, and typically for a really good run for a movie will do about 10% of what a 3-day weekend was. But this film, at least in IMAX, did 10% of a 4-day weekend. So we had done about 34 million for the Memorial Day weekend, and then we did 3.4 million on Tuesday. So every sign you look at shows that it's really going to play for some time. And then in only a week and a half, as you mentioned, you have Jurassic World out of the lineup. You left out Lightyear from Pixar. You've got Thor coming. You've got Nope from Jordan Peele coming. You've got Black Panther later in the year, biggest movie of all time, Avatar, the sequel. So there's just no doubt in my mind that movies are open for business and they're going to overperform.
I'm excited about so many of those titles that you mentioned, Richard. I wonder, though, for consumers who are also excited, how much of a premium they're willing to pay, recognizing that ticket prices are higher right now.
Yeah, I mean, I can only answer that in the context of IMAX. And, since the pandemic, both our market share has been going up and our indexing, which our indexing means the percentage of the movies. So we did 14% of the domestic box office on 1% of the screens over the weekend. And we did 14% again yesterday. And our ticket premium is usually $5 or $6 over an ordinary ticket. So, that's a bigger indexing, and our market share has been going up. So I think for quality, people will pay up. And I think it's the same thing has been evident in other forms of entertainment, whether it's sporting events or rock concerts. I think people just spent so much time sitting on their couch that if they get something really special like IMAX, they're going to be happy to pay more for it.
I can't sit on my couch anymore, Richard. There's a big dent in it because of everything that's been happening in the past 2.5 years. But let me ask you this. Last time we talked to you, Shanghai and China was still locked down, key market for your company. What are you seeing in that region now?
Well, today is actually a key day because yesterday Shanghai announced that it was relaxing a lot of its restrictions and it was on its way to opening up. So I don't remember exactly when we talked last, but it was about 70% of IMAX theaters were open in China. It's now about 85, maybe even a little bit higher. So it's definitely starting to come back. As I said, Shanghai, Beijing, restrictions coming off. Maybe what's most important to me is that movies started getting dated again in China. So if you look at Jurassic World, that's opening up day and date, June, I think it's the 10th, with the rest of the world. So for them to announce a big Hollywood opening on that day, I think they're expecting business to start to return to normal. And then there's a big Chinese local language film called Mozart in Space, which is opening around July 15th. And again, they just announced that that was dated. So I don't think you'd see the combination of the announcements and the reopenings unless they had some confidence that things were going to start returning to normal.
Across the footprint of IMAX locations that you have, I mean, that's an astounding index that you do. 14% of the domestic sales this past weekend on 1% of the screens that are out there. But I also think about what's necessary to operate the number of screens and locations that you do have, even if it is, such a comparison and kind of a fraction of what is required for some of the larger movie theater chains that are out there. How are you navigating retention right now?
So we don't operate the theaters, our exhibitor partners do. So one thing that's very desirable about our business model is when it opens, a lot goes right to the bottom line. We don't have fixed costs. We don't have leases. We have no net debt in the company. So when our revenue stream returns to normal, a lot of it just falls down to operating margin. And then once we cover SG&A, bottom line margin. So there's not a lot there. On the indexing, I may have left out something that was even more impressive, which is over the weekend, we did about 8.5% of the international box office. And we're a lot less than 1% of the screens on an international business. So it's a really high operating leverage business. And it's built for now. When the movies reopen and there's big box office, that's when, we make a lot of money. And you could see it, our results in the fourth quarter last year. The fourth quarter last year was our best fourth quarter ever. And it beat 2019 in terms of box office, which was our best year ever, 2019, for the fourth quarter. So, the cost of operating for us is very minimal. It's the exhibitors that operate it.
And Richard, just given the comeback of sorts here for the movie theater industry, do you think the industry is now getting ready to go back into growth mode? Because before pandemic, you had the likes of AMC and a lot of its rivals too out there opening a good number of new theaters here across the country.
I can't really address the model for exhibitors because IMAX is not an exhibitor. We're a technology license company. We don't own real estate. We don't lease real estate. We don't have debt. We license our IMAX technology to exhibitors that have those characteristics. So for them, the challenge is really, getting back to that break-even point and what the size of that box office is before they cover their fixed costs and then contribute to earnings on the bottom line. As I said, we have very little fixed costs, so it's just a different model. And I think you'd have to look at it on a case-by-case basis. We've been profitable on the EBITDA line and cash flow for over a year and a half. I don't know any of them that have been. So, one of the things that drives me crazy is when people compare us to exhibitors, because we're a totally different kind of animal.
Absolutely. Always great to get some time with you. Richard Gelfond, IMAX CEO. Always good to see you.
COVID cases on Memorial Day this year outpaced COVID cases from this time last year, underscoring the continued importance of vaccinations. Novovax seeking to get U.S. authorization for its 2-dose vaccine soon. For more on this, let's bring in Novovax Chief Commercial Officer John Trezino in an exclusive Yahoo Finance interview, as well as our very own Yahoo Finance's Anjali Kemlani, who's going to join us for this conversation. John, it's great to have you on the program. June 7, as I understand it, is the meeting. It's the first of 4 that need to happen for your vaccine to get approved here in the United States. And then at some point, you're going to go on to the CDC. Give us the update on where you stand in that and what's your expectation at the end of all of this.
Yeah, thanks. And thanks for having me. The lead-in was exactly why this is such an important event for us, coming up on the VRBPAC. So FDA's advisory committee, which will assess all of the data that we've submitted to date, will make their assessment and make a recommendation for emergency use authorization to be granted to the FDA. And so it's a culmination of a lot of work and effort that's gone into all of what we provided with from clinical data that we have a safe and effective vaccine, and that COVID is here to stay. We now offer an option of the first protein-based vaccine to be authorized for use in the U.S. And I think we're tremendously excited and optimistic about the outcome of that meeting on Tuesday.
John, Anjali here. Good to have you on. I know that there is a lot of focus about the manufacturing and the doses coming from the Serum Institute of India and being sent over here. Obviously, we live in a world where we know that there are supply chain pressures right now. How do you plan to ensure that these doses make it over quickly and smoothly and you don't run into any logistics issues?
Yeah, so we've been shipping products since the beginning of the year, and Serum Institute has just been a tremendously valuable partner. They've built out capacity for us over the last couple of years. They are an absolutely world-class facility. They've now been inspected by the FDA, and that was a gating event to the VRBPAC meeting. So 100% confident in their ability to manufacture and deliver. We've been shipping into Europe and Australia and Canada and many other countries around the globe. So 100% confident in our ability to bring doses into the U.S. and doses will be in the U.S. in a few short weeks after the emergency use authorization is granted.
Walk us through that timeline and whether or not you actually see any doses being produced in the U.S., because I know you had to stop production with a U.S. contract manufacturer. Has that relationship completely ended, and are you using any others in the U.S.?
Well, most importantly for the moment is the submission to and review by VRBPAC and submission to FDA is based upon the Serum Institute manufacturing a product. As you may recall, we made a decision in August or September of last year to focus our CMC activities, our manufacturing activities to Serum Institute so that we could get the regulatory filings submitted as quickly as possible. And that proved to be the right decision. We will be adding and supplementing those regulatory filings for facilities at SK Biosciences and then our own manufacturing site in the Czech Republic in Europe. And that will be, at least for this year, the sites that we'll be using for manufacturing.
And what about,
and the product that will be available in the U.S. will come from Serum, at least initially.
Okay. What about the stock itself for the company? I know you've seen it really on a roller coaster ride since February of last year when you had to really announce that delay. We've seen over the course of the pandemic, different vaccine companies experience different interest in investors' sentiment. Right now, really, the company's under pressure for waiting to see that U.S. approval. Do you anticipate that will sort of boost investor confidence?
Yeah, so the market's fairly unpredictable at the moment, as we all know, right? I think there's a high degree of volatility. We feel like we're trending in a similar way to many of the other COVID vaccine manufacturers. It's been a downward trend, but it's not reflective of our value. I think we are now in a position to have a successful 22. You remember that we have $4 to $5 billion of revenue guidance for 22. We also believe 22 is an important foundation-laying year for us as we see and look toward what will be a transition out of the pandemic into normal kind of commercial vaccine selling. And that's going to be an important turning point for us as well. We believe we're going to have sustainable revenue generation and be an important part of annual revaccination for COVID into the foreseeable future.
Yeah, so John, let's pick up on that point because I know you've been asked a lot about the timing of this product coming to market. We're more than 2 years into the pandemic. In developing countries, at least, many are on their second booster shot. What does the demand outlook look like for you? And where are you likely to see the biggest demand?
Yeah, again, I refer back to the lead-in, and I think it's critically important for everybody to understand that there's still a significant amount of virus circulating around the globe and around the U.S. for sure. And so it's off a bit of the front page in the headline news, but it still is something that we need to be concerned about. We need to focus on. We're not yet sure whether it's going to continue to be 6-month boosting or annual boosting. But what we do know is there is going to be a continuing high demand for vaccine across the globe, and we'll wait to see exactly what that is. But certainly, clear need for vaccine and clear need for revaccination programs.
Just today, 2 high-profile SPAC deals involving ticket reseller SeatGeek and media company Forbes collapsed. For more on all this, let's bring in Michael Dambra, University at Buffalo Associate Professor of Accounting. It's great to have you on the program. Again, this was kind of the darling, if you will, of the market activity during 2021 and most of the pandemic recovery. But it seems like now concerns about not only SPAC deals not getting done, but perhaps SPAC deals that were done not even making it only a few years out. What do you see as the biggest issues facing the SPAC world right now, Michael?
So I would say there's a couple different things going on right now with SPACs. Number one, the way these things got priced oftentimes was based on revenue projections. And the revenue projections were extremely high. And so you had firms going from $0 of revenue to $0 of revenue to $0 of revenue to $4 billion. And so there was a lot of, during that SPAC spike, there was a lot of interest in SPACs. And when we watch the cash flows come in, they're just not coming in as projected. And since these things are priced based on those forward multiples, it creates expectations that aren't getting realized. And so cash flows aren't coming in, which makes firms, which gives a little substantial doubt that these firms will sort of continue and be able to stay active in public markets.
Michael, let's talk about some of the numbers here. At least 25 companies that have issued going concern warnings, 10% of the total number of SPACs that went public between 2020 and 2021. How much of this do you peg to a lack of regulation, guardrails? I mean, we know the SEC has since come out and proposed these additional disclosures. Do you think the number would have been pulled back significantly if those disclosures were in place?
I would hope so. The problem when you look at those investor presentations, when they actually project out revenues, you see huge amounts of growth, but there's not a lot of historical information. So the SEC is really pushing for comparative disclosures, both on revenue projections versus what the company's done previously. And where the real activity was, where those merger announcements really generated a lot of positive returns, a lot of retailers were buying. And so if there was more equivalent disclosure, that might have sort of prevented this sort of pop we're seeing in SPAC markets and then the sort of subsequent decline we've seen now.
Michael, you talk about regulation and kind of the ways by which there are guardrails around the SPAC world. One interesting thing that you flagged before is just kind of safe harbor protections, which have existed for SPACs, perhaps some interest from the SEC to remove those protections. What would that do? Do you think that's a good policy to address some of the things that we've been talking about so far?
Yeah, that's a two-pronged question. I mean, first, if the safe harbor goes, a lot of these firms are going public through a SPAC for that very specific reason. They're very speculative. And so there's an opportunity or a window to actually tell a story through projections that you can't do through a traditional IPO. If you get rid of the safe harbor proposal or the safe harbor protection that the SEC has proposed, I think that'll sort of kill that sort of avenue for these firms to go public. And I think that will decrease IPO volume. Whether I feel like that's appropriate or not, I'm sort of mixed because it did bring more firms to the public market. But I think the issue was, I think a lot of retail investors in particular are misled into these crazy growth stories. Not every one of these SPACs is going to turn into DraftKings or Virgin Galactic. A lot of them are going to be like these flying helicopter companies that just can't stay in business.
So let's talk more about those retail investors, Michael, because there's a lot that are watching who are saying, look, I bought into one of these SPACs and yet they didn't end up acquiring a company specifically. Then what happens?
I mean, if it's still in the SPAC process, they have an opportunity to get their initial investment back. So there is some protection if the merger goes through. But if the SPAC liquidates, there should be enough capital to get back to retail investors. However, if the acquisition happens, it's an already acquired company, that's where we see a lot more problems. I mean, since 2021, the firms that have gone public via SPAC are down at least 60% as of last week. And so the initial investment you made and you held on to during the SPAC acquisition, you're not getting that back once you're a traditional public company.
COVID cases, they are surging in the U.S., averaging over 100,000 a day, up 30% in just the past 2 weeks. And many cases are going unaccounted for in official reports because people simply are not testing. We want to bring in Dave Hickey. He's the president of BD Life Sciences, the maker of both clinical and at-home COVID tests. And it's great to have you here, Dave. Curious just in terms of, we have cases surging, people aren't testing. What are you seeing demand-wise from your business? When we see cases jump, have you seen the sales of your tests increase at all over the last couple of weeks?
Yeah. So, Shauna, thank you so much for having us on the show. And, from BD's perspective, as you rightly said, we've had multiple point of care tests approved under the emergency use authorization, as well as the lab-based molecular tests. We definitely saw and consistent with what we've said in earnings releases, we definitely saw our spikes in the first and second quarter of BD's fiscal quarter. But now we're starting to see some demand a little bit. But certainly the peak for us with the point of care and the lab test was definitely a first and second quarter.
Do you have any data though? I mean, anecdotally, I have 2 COVID test sites right near me and they are empty 24 hours a day. They were packed a year ago. Do you have data to support how far down testing is today, despite cases skyrocketing?
Yeah, so no, in terms of the most current data, that is not available. I mean, obviously we're still, going through our quarter 3 earnings right now. What I would say is that we have maintained inventory, we have maintained supply. We've got very strong distributor partners who've got inventory ready in their channel. So should the demand pick up, we're ready to respond through our direct and distribution partners for either lab-based or point-of-care diagnostic tests.
Dave, how do you see the at-home test market evolving? Because yes, people are sick of COVID, people are sick of talking about it, they're sick of testing for it, but COVID isn't going away.
Yeah, so great question, Shauna. And I think, when I reflect back, if I think back over the last couple of years around the pandemic, and even right now with the surge in cases, it just shows how critical the role of diagnostic testing is. And I think there probably isn't a person on the planet that hasn't heard of a lab-based COVID test or a point-of-care rapid test. And I think there's room for both. And I think what the pandemic has done, particularly with point-of-care testing, it's created an opportunity, and one that we're excited about, that we think point-of-care testing is absolutely set to continue. So when we think about it, and to your question, will the COVID pandemic become more of an endemic? So here in the US, it becomes more of a respiratory virus, where, again, solutions that we have in the marketplace and solutions that we're actively developing for at-home testing. Imagine if you could actually do a flu A, a flu B, and a COVID test in the respiratory season if you were symptomatic to know whether I've got flu or COVID. So I think the role of point-of-care testing, self-testing, is set to continue. Also, the role of point-of-care testing, if I think back through the pandemic, even with hospital and hospital networks that have had to manage when all the hospital beds were full of COVID patients, they managed high acuity patients at home. So there's a lot of dialogue right now around the hospital at home, the virtual hospital, that's still going to look for these types of diagnostic solutions that are connected into hospital ecosystems. Both of those opportunities we're extremely excited about.
Dave, our at-home flu testing, is that the new reality? And God forbid anything like COVID ever happens again, how much better position is this country going to be in?
So I think, obviously a lot of our industry as a medical device diagnostics agents arena was enabled by the FDA working with the emergency use authorizations in a public health emergency to facilitate COVID. But I think we've also got very comfortable with the role of self-testing or testing in point of care areas that was non-traditional when you think about places of work, school, universities, and so on. So I think, whilst we need to see how this evolves, but I do think, if I think about unmet needs, if I think about opportunities, maybe not under the emergency use, but, through a regular 510K proven safe and effective trial, I think it would be a huge win if we could do flu COVID testing at home.
The Great Resignation showing no signs of stopping. Another 4.4 million Americans quit their jobs in April, according to a report released today by the Bureau of Labor. Gen Z continues to lead that way, but why? Jason Dorsey is a researcher and the author of Z-Economy, How Gen Z Will Change the Future of Business and What to Do About It. Jason, good to see you. So a new report from Deloitte says that 40% of Gen Zers say they'll quit in the next 2 years. Why? Yeah. And what are the implications?
Yeah, well, the reasons why are many, but some of them are really obvious. The generation has just gone through this pandemic. They were the number one, people get this wrong all the time, they were the number one generation laid off during the pandemic, or loss of jobs, loss of hours, loss of pay. And so, of course, they're trying to make up for lost time, which is what we're seeing right now. They also have more leverage as employees than they've ever had, and maybe they will, in terms of job opportunities and signing bonuses and a variety of different things that they can do and sort of leverage at this moment. And they have the least responsibility in terms of family, child, houses, cars, and so forth. So it's really a perfect time for them to make that jump. And what's interesting to me about the statistic you cited is 40% of Gen Z say they're going to leave a job in the next 2 years. But for many of the companies that I work with, if they could keep 60% of their employees 2 years from now, they would think that's a huge success. So while these are big numbers, the key here is it's a really tough time to keep every generation, but in particular Gen Z. And we've been tracking this for many years in our research, and we don't think it's going to go away. In fact, we believe as Gen Z continues to move into the workforce, have more skills, more experience, become even more valuable, they're going to actually get more leverage, which is an opportunity for employers that know what to do, and a real challenge for those that try to take it on as business as usual.
Jason, that's a lot more turnover than I think I was initially expecting here from companies. But my question to you, when it comes to Gen Z, there's so much focus on Gen Z right now because they're entering the workforce, lots to talk about. But how much does it differ than what we saw from millennials, just in terms of wanting to leave, maybe wanting to change their job within the next 2 years? Is that similar to what we've seen from previous generations?
It's a brilliant question, and sort of yes and no. The yes is it's similar to what we saw with the oldest millennials who crashed into the Great Recession. I was one of them. We crashed into wage stagnation, rising cost of living, job loss, all of these things. And then once the economy turned around, we saw lots of people change jobs and find new jobs and re-enter the workforce. The difference here is how young Gen Z is, and that it's socially acceptable within the generation to change jobs. And now, I would argue, for the first time, employers are hiring people that have had short-term stints somewhere else. What do I mean by that? There used to be, well, if you didn't work somewhere a year, we're not going to hire you. You're not loyal. And now they're like, oh, you've worked somewhere at all. Well, thank you. And so that's really shifted in the favor of Gen Z in a way we haven't really seen in many, many years. Now, the interesting part is that the millennials you referred to, they're now the managers of these same Gen Zers. So the millennials who caused all these challenges are now the ones managing the Gen Zers going, well, y'all are leaving jobs. You're getting hired. You're not even showing up. Ghosting is a huge deal. You don't want to work 5 days a week. What I love is one of our new studies in our State of Gen Z study, we found that 44% of Gen Z said they had to work 5 days a week if they really wanted to get promoted. However, a majority of Gen Z still would not work 5 days a week in an office.
So they don't care about getting promoted. At the end of the day, that shows a lot about their motivations.
Yes.
So that Deloitte report I mentioned earlier showed only a quarter of Gen Z can comfortably pay their living expenses. Nearly half live paycheck to paycheck. Given what you told us, is their priority work-life balance or is it salary?
Ooh, so it's interesting because we see differences based on sort of where they are in terms of socioeconomics and other safety nets. Do they live with their parents? What can they fall back on? There's a lot there. But the interesting piece is in our research, starting salary, the importance of it has gone up dramatically over the last 12 to 24 months. Everything else we study that attracts Gen Z to a job or gets them to stay, pretty much the same. In fact, workplace perks, the fancy coffee and all that sort of stuff has actually fallen, and starting salaries moved up dramatically because they're trying to make up for lost time. But what's interesting is they're also pushing back and saying, yeah, I want to earn more money, but I don't want to work those same hours or same days. Now, there's a bit of a misread, at least in terms of a solution that we've uncovered. Most employers say, oh, Gen Z, they don't want to work 5 days a week. But what we found is Gen Z actually will take jobs working 5 days a week if they can pick the hours, move the hours around a bit, then work more days. But if the hours are inflexible, then the days become really important. So there is a silver lining that employers can take action now that will get Gen Z to work for them and be loyal. But doing what they used to do pre-pandemic will not work now. In fact, for those that are watching, there's three key things we see that employers have to offer. First, it's that starting salary. Second is some sort of flexibility. And then third are benefits. And benefits are unusual because, as y'all talked about, this is a younger generation. You know, the oldest are now 26, but they care deeply about retirement matching and all these different benefits that often aren't talked about. And one of my favorite discoveries from a new study is many in Gen Z actually want stability when it comes to an employer, and many employers are not talking about stability. In fact, you know, I got to listen to your segment before this and all the layoffs and change in big companies. Stability is suddenly going to be very important to Gen Z as they look ahead. So both life balance is important, as well as starting salary, and finding a combination seems to work. We referred at our research center, we don't call this the Great Resignation. We call it the Great Realignment, because really what we're finding is that people are sort of realigning their schedule, their work, and on these deeper priorities, sort of values clarification, if you will, that happened through the pandemic. And now they're saying, oh, I want to be able to do these other things and also have the leverage as employees to do that now. It's a really tough time to be an employer, a great time to be in Gen Z, and we've got to find a way to bridge those two.
All right, it certainly sounds like a lot of changes maybe on the way for the workforce. Jason Dorsey, thanks so much for joining us.
Joining us now with his reaction, Bernstein U.S. Internet Managing Director Mark Shmulik. Good to see you, Mark. So what was the impact of Sheryl Sandberg on Facebook Meta as we know it?
Yeah, thanks for having me. The impact is immeasurable. I think as you justly described, they grew it from a startup to a real business, driving the revenue growth engine to the point where there's north of 10 million advertisers, 200 million businesses participating in the Facebook ecosystem. So she's certainly been a pillar and one of the two leaders there alongside Mark that effectively have built this company into the behemoth it is today.
Mark, without Sheryl Sandberg in the day-to-day operations, I guess, is that changing your view, your outlook on Facebook at all?
No, not materially, and it's one we're still digesting as kind of the news breaks and we see what the new leadership structure looks like. I think it is fair to say that she's, slowly started to step back from activities. I believe she was on sabbatical actually a little bit earlier this year. And so I think as Facebook kind of enters into its next wave of growth, the Javier taking over, certainly fits the mandate of effectively where Facebook or now Meta, which is changing its ticker symbol next week, goes from here. And it's really more about an integration, of effectively their core applications alongside Reality Labs. And that's kind of really Javier's strength, is this kind of cross-platform integrations. And so, I think this is really just about what the next wave of growth is, both for the company, and so it kind of feels like an opportune time. If Sheryl was to step away, this feels like, the time to do it.
Mark, I want to ask you, do you think she's leaving because they're transitioning to Meta, that they're no longer going to be the Facebook that it was, that she came on and helped, essentially build out from what it was? Is that why she's leaving, do you think?
It's hard to speculate on why. Certainly, I think a lot of her strength has really been about building up the businesses, the ad business, and as we look ahead to where growth comes from, certainly there's more to do there. As they look to monetize Reels, but a lot of the chatter and a lot of the ambitions about Meta are certainly now broader, going into reality labs in the metaverse, going into e-commerce and shopping, going into the business messaging, which they had their conference, just a couple weeks ago. And so as we expand kind of beyond that core business built today, it certainly feels like, if she kind of feels like she accomplished, her job of building it up to the business it is, I think you could say mission accomplished, and then time for somebody else to step in to grow into those other, ambitious initiatives.
Yeah, you can't help but wonder if she's not necessarily all in on the future of the metaverse. It certainly leads one to believe. Looking at the stock, the markets have judged not a huge impact, down 2% on the day. This news did break before the closing bell, and after hours, shares are flat. So is the market saying no real impact on the future of the stock price?
Yeah, I think that's fair. Look, certainly the stock has been hammered, this year, alongside the rest of tech, but certainly even a little bit more so, given what happened on the February earnings call. And I think it reflects just the nature of, where she is today and where the business is today. And the ad business effectively functions at this point at scale. And so if we look ahead to kind of what's next, perhaps the best analogy I can draw, and it's certainly not the CEO seat, reminds me a little bit of, Sundar Pichai kind of taking over Google. Feels a little bit of, Javier now stepping into that role to take the company, to its next wave of growth. And I think that's starting to be reflected a little bit into the company, because certainly I think a lot of her largest impact was earlier on, and her role is kind of, as I mentioned, she's been stepping back a little bit more recently, which makes it more of a softer landing here. Yeah.
That's an interesting comparison there. Mark, when we take a look at the share price and the performance that we've seen in Facebook since the beginning of the year, obviously with the sell-off that we've seen in tech, they are far from the only stock that has been hammered. But from your perspective as someone who closely watches Meta day in and day out, what do you think they should do, or what do they need to do in order to kind of turn around that perception right now and convince Wall Street, convince investors that this is the way to go?
I think the answer is going to be in the fundamentals, and I think it just speaks to the markets we're in today, where it's not just about top line growth, but it's about delivering, earnings and returning capital to shareholders. And so, we're now going to enter a period where certainly the second half looks a little bit more appealing than the first half, as we start lapping some of the headwinds tied to IDFA, and we start seeing Reels monetization ramp up. And certainly, if they could show investors monetization progress on any of these other initiatives. I've always referred to these, internet businesses as they've got great cash cows, and that's what Facebook has, or Meta has. They have an advertising cash cow. What they need to start showing investors is the ability to generate revenue and to drive profitable growth, in other things like, Facebook Shops, things like business messaging, and certainly Reality Labs. And so perhaps this is a moment of transition where we as investors will be able to watch and see progress against some of those other initiatives.
Is Javier the person for that?
It's hard for me to say. Certainly I think the role that he held in the company was really one about driving some of those cross-platform initiatives. And I think in Mark Zuckerberg's kind of Facebook post, he kind of mentioned the path forward is really about closer integration across these applications. That's effectively the role that he's functioned in, is trying to drive collaboration across Instagram, Facebook Blue, Messenger, and WhatsApp. And so certainly at least the skill set is there to drive kind of that collaboration efforts going forward. And so at least from my seat, feels like a natural fit for at least the way Mark has described the role and what he wants from it.
The president cited surprising data that there were more new small business applications last year than in any previous year. We want to bring in Jen Flynn, Capital One, head of small business bank. And Jen, it's good to see you. Capital One is out with its small business confidence report. What did you find? Are small businesses as optimistic as President Biden says they are?
Thank you for having me. So the past 2 years have been incredibly challenging for all of us, and small businesses have been hit really hard. Our research shows that small business owners are optimistic, despite the fact that inflation, supply chain issues, and burnout continue to be worrisome points. In fact, an overwhelming majority of business owners tell us that they are just as, if not more, motivated to grow their business now than they were before the pandemic, which is really encouraging.
You know, we see on the screen the top challenges for U.S. small businesses. I expected the tight labor market to be, if not number one, certainly number two. How are they getting around that? I mean, I see businesses every day that cannot hire enough employees, restaurants that are half closed because they can't have servers. We're seeing pools around the country closed because they can't get lifeguards.
Candidly, I was equally as surprised. This is always a top stressor for small businesses. And in our survey, it's fallen pretty low on the list. And I think what we're seeing are small businesses have found a way to differentiate with flexibility and benefits. And they made a ton of investment in technology during the pandemic that's paying off and allowing them to offer remote work options to gain attractive talent.
And that's interesting there, Jen, because what else, I guess, are small businesses doing if they're not having the problem? Obviously, maybe they're turning to technology so they don't need as many workers as they did in prior years, but they're doing something else to attract this talent that's out there. In addition to flexibility, what are they doing? Because they don't have the deep pockets that some of those larger corporations have.
Yeah, so we're seeing a heightened emphasis on really focusing on the company mission, engaging associates in the planning stage, the strategy sessions, creating space for associates to have time for themselves, emphasizing self-care and well-being, not only for their employees, but also for themselves. And I think this human element is very well received coming out of the pandemic.
And that number that Shauna quoted earlier about more businesses opening in 2021 than any other year shows that something related to COVID made people want to launch businesses. What's the biggest evolution or lesson for small businesses coming out of COVID?
Yeah, I think it's technology, right? I read a recent McKinsey study that said the tech transformation accelerated by 7 years during the pandemic, and small business was on the forefront of that, right? Consumers were expecting businesses to meet them where they were, and associates were looking for remote flexibility and optionality. And small businesses came through and delivered, investing in that tech agenda. We're also seeing more, and I'm hearing more small business owners have actually moved to an entrepreneurial space because they want control of their schedule. They want that flexibility. They want that opportunity to care for whether their children or loved ones as they had to during the pandemic, and starting their own business is giving them that optionality.
Jen, those who are starting small businesses, any idea just in terms of their ages? Are we talking millennials? Are we talking older generations, younger generations, Gen Z? I mean, who is it?
So we're seeing a rise in women-owned businesses, minority-owned businesses, millennial-owned businesses for sure.
All right, thanks so much, Jen Flynn, Capital One, head of small business. We appreciate it. Thanks so much.
In this episode of Influencers, Hermitage Capital Management CEO, Bill Browder.
Are we ready to go to war? Is the United States ready to go to war with Russia? I think that this is going to lead to a Russian depression. I can't imagine how this stranglehold doesn't really drive the GDP down like 20%, 25%. It's remarkable. And we're just in the early stages of this game. The Ukrainians are not gonna roll over. They're gonna fight like hell.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Bill Browder, CEO at Hermitage Capital and head of the Global Magnitsky Justice Campaign. In the late 1990s and early 2000s, Browder's firm delivered stellar returns by exposing corruption at major Russian companies, bringing about company shakeups and boosting share prices. In 2005, Browder was denied re-entry to Russia and later became a victim of a Russian government scheme to undermine his firm, he says. Sergei Magnitsky, a lawyer hired by Browder to investigate Russian corruption, was arrested and died in Russian custody. Bill, welcome to Influencers. Thank you so much for joining us.
Great to be here.
So much to get to right now. I want to ask you maybe first of all about Vladimir Putin. And have you ever seen Putin reverse course in 25 years of watching him closely? Can you see him changing his tack now in Ukraine, now that he's committed to a full-scale invasion?
That's that's the most important question of our discussion. And the answer is a definitive no. Vladimir Putin can't, you have to imagine his world is the world of a prison yard. In a prison yard, you can't show any weakness. If someone comes at you with a shank, you got to shank them 10 times more and look around at everyone else and say, who else wants to be shanked? That's Vladimir Putin's mindset. That's how he operates. And so when he has embarked on this horrific military invasion, there's no chance. Anytime he announces peace talks, that's just a tactic to either split up the resolve of the West or to delay some action to resupply or something like that. And so he is going to move forward. He's going to escalate. There's no retreat. There's no compromise. There's no diplomacy. He's all in it for victory, however he defines that.
And so a lot of people use this phrase end game, Bill, but I'll ask you, I mean, what is the end game here, specifically with Ukraine first? And does he want to occupy it, or how would this work in his mind?
Well, this is another important part of Vladimir Putin. There is no end game. So what you have to understand is he is not there for all the reasons that he says he's there. You can't believe a word he says. He's an inveterate liar. His credibility is zero. And so any words that he has used to describe what he's doing should be discounted. The reason that he is in Ukraine is because after 22 years as a dictator, he sees the writing on the wall. He sees the writing on the wall, meaning that the Belarusian dictator next door was almost overthrown 18 months ago by his people. The Kazakh dictator, again, next door in a different direction, was overthrown. And Putin realized that it was just a matter of time before the Russians overthrew him. And so, pulling straight out of the dictator's playbook 101, he said, what do you do to not get overthrown? You start a war. And he's described Ukrainians as Nazis and drug dealers, and he's described NATO as an invading force and all sorts of things. He doesn't believe any of that. He's just trying to come up with a narrative to give the Russian people something to chew on in order for him to have a war, and his war is there to stay in power. And so when you say, what is his end game? There is no end game. His end game is to move forward, to expand, to attack, to take territory, to declare victories. But he has to keep on going no matter what it is. And this is just part of that process. And it's not like it just started now. I mean, the most recent version of this just started now. He was feeling under pressure in 2008, and that's when he invaded Georgia. In 2014, the same thing. He took Crimea. And so this is a long process of him trying to stay in power as a dictator. And the most scary part of this whole story is that I don't have any belief that he will stop. So let's just say that he's successful in Ukraine. And that's a very big question because the Ukrainians are valiantly fighting back. But let's say he was successful in Ukraine. That's not the end of his story. He would then go to other countries, maybe the easy ones, maybe the hard ones. Maybe he grabs Moldova at some point. But the ultimate goal for him is to show up at the border with us, which means Estonia or Latvia or Lithuania or Poland, and then to test out something that has never been tested before, which is, are we ready to go to war? Is the United States ready to go to war with Russia to protect Estonia, a country of 1 million people that probably 2% of Americans could locate on a map? Are we ready to do that, or are we not? And he's taken the bet that we're not.
But isn't this going to be very difficult for him just to hold on to this real estate? I mean, look at Afghanistan, very different country, certainly, but look at Afghanistan under Brezhnev. I mean, there's a huge cost to occupying these countries, right?
Absolutely. So I was just saying, I was saying that's his assumption, is just keep on pushing out. Now, let's talk about Ukraine specifically. So he's launched an invasion of Ukraine. We don't know the exact number of casualties, but I've read various reports to say that there's 3,000 soldiers have been killed in the first 4 days of their occupation. I don't know if that's true or not. Maybe it's wildly exaggerated. Maybe it's totally true. But let's just take for a moment and say it is true. That's the total number of soldiers that died in the entire war with Chechnya. That's like a third, or between a quarter and a third of the total number of soldiers that died after 9.5 years in Afghanistan. And so he's paying a hefty price, even if it's just a fraction of the 3,000. He's still paying a hefty price for what he's done so far. And we're just in the early stages of this game. The Ukrainians are not going to roll over. They're going to fight like hell. Thankfully, now after some resistance, all of the major Western allies are going to assist them with equipment to help them fight and give them some decent chance. But at the end of the day, Vladimir Putin is way outgunned them. I mean, he's got all sorts of stuff. Right. There was, shocking military hardware that could really, be unbelievably destructive to people in Ukraine.
it appears, or one could argue, that the Ukrainians are winning the war of social media. And I'm wondering if Vladimir Putin, who supposedly was this expert in disinformation in social media, has underestimated the Ukrainians' abilities there.
Well, so the Ukrainians have had some help, and as critical as I am on some aspects of U.S. foreign policy, the Biden administration has done a fantastic job early on of sharing intelligence about what the Russians were up to and repeating it and repeating it and repeating it. So by the time the Russians invaded, there was no alternative narrative. So the way the Russians normally do this, and they did this with Georgia, for example, there was like confusion to this day about who fired first in Georgia. And the Russian apologists said, well, it was the Georgians who precipitated and provoked this war and so on and so forth. There's no uncertainty about this. This was a war of aggression. And that's a very important term. A war of aggression is the term they use in the Nuremberg trials. This is a war of aggression that everybody can agree on. And so there's nobody who no sort of natural Russian apologist, nobody who's got a lot of financial interest with Russia who can say anything other than this was a brazen attack on a peaceful neighbor. And that's an extremely important part of the narrative that has allowed all the Western countries to lock arms and do the coordinated sanctions that have been done right now, which are causing enormous financial pain to Vladimir Putin.
Yeah, let's drill down into that, Bill. Sanctions. How effective are they right now, and what grade would you give them, for instance, and what do we need to do from here?
So I'm a sort of connoisseur of sanctions, if such a thing exists. And so when they first started this sanctions program about a week ago, last Tuesday, I would have given the Western governments a 2 out of 10. It was all very, too little, too late. Then the atrocities started to happen, and the sanctions started getting real when they added the major Russian banks, the big oil companies, et cetera. By Thursday, it was an 8 out of 10. Then they did SWIFT. That's a 9 out of 10. And then they did Vladimir Putin and 9.5 out of 10. So there's still some gaps that need to be filled in. SWIFT is only done, so SWIFT means disconnecting the Russian banks from the international financial system, and they've only done 70% of the banks. And so logic would tell you that if 70% of the banks are disconnected, they'll just route all the payments through the 30% of the banks that aren't disconnected. That's just what anyone would do, and certainly the Russians will do that. And so we need to sanction the other 30% of the banks. And a lot of people ask me, why are those banks protected? And I can imagine that there was some, ugly backroom deal with, in a smoky room where somebody said, we have an interest there, don't do that. But so those other 30% of the banks need to be sanctioned, disconnected from SWIFT. And then the most important part of the whole exercise is that Vladimir Putin's own money needs to be hit. And his own money is held not by himself, but by oligarchs who look after it. And so we need to freeze the assets of the oligarchs in the West. And a lot of announcements have been made that that's the intention. A few oligarchs have been added to the various EU, US, UK sanctions lists. But that needs to be done in a much more coordinated manner, because there's different oligarchs in the US that have been sanctioned in the EU and different ones in the EU than the UK. And then the list needs to be expanded dramatically. So there's 50 or 60 or 100 of the most wealthy oligarchs in Russia sanctioned. And if we get
God, let me interrupt. I'm sorry, Bill, but practically speaking, how would that be accomplished? Isn't that extremely difficult? You've got Caymans and countries like that, and I don't mean to disparage them specifically. There are all sorts of money havens around the world. Never mind Switzerland, which has said that actually they're up against Russia at this point. But how would that be done practically?
Well, it's actually not as complicated as you think. So, so it's not the government's job to necessarily track down the assets. The way it works in practical terms is a person gets added to the sanctions list. Once they're on the sanctions list, then it's the job, or the responsibility, not the job, but the legal responsibility of a bank that holds their money to no longer transact with that person. So that money gets frozen, or a real estate agent not to sell their property, or a broker not to sell their shares. And at that point, everything gets frozen. And so it effectively gets crowdsourced. Now, you made a good point, which is, let's say their stuff is not in the United States or in the UK, but in the Cayman Islands. Well, guess what? The Cayman Islands is a crown dependency. And as a result, every one of these Guernsey, Jersey, Isle of Man, Cayman Islands, British Virgin Islands, they copy the British sanctions list. And so you end up in a situation where whatever Britain does, all these offshore jurisdictions do. And so Britain is really punching way above its weight in terms of its importance in this whole scheme. And so just coming back to the original thought, you put a person on the sanctions list, they get sanctioned everywhere, Cayman Islands, BVI, UK. And if all the countries coordinate, then there's really no civilized place they can hide. Now, we're seeing oligarchs scrambling right now, moving yachts. I read a story about one oligarch who's parked his yacht in Saudi Arabia, okay, because he doesn't think that the Saudi Arabians will freeze his yacht. And there's stories about mad scrambles of oligarchs trying to sell properties, give them away to family members, and getting divorced from their wives and giving them property, all sorts of interesting stuff. And that will happen, and they will probably succeed in protecting some of their assets. But even if you don't get all their assets, just having a person on the sanctions list means that they're no longer, that they're pretty much out of the game. They're benched in the world, in the international financial world.
Another remarkable development, or correct me if you think I'm wrong, Bill, is the response by the private sector, both in Europe and in the United States. I mean, everything from Disney to Shell to the banks curtailing or ending their financial relationships with Russia. What do you think about that? And is this effective?
Well, in a certain way, I would almost argue it's more effective because, okay, so the sanctions lists are important, government activity is important, but if every Western company stops doing business with the Russians, it's really dramatic. I remember when I started my whole campaign for justice for Sergei Magnitsky, my murdered lawyer. One of the first people I met with, I was in South Africa, and I met with a woman named Helen Zilli, who was one of the people involved in the one of the main people involved in the anti-apartheid movement. I'd watched a movie called Cry Freedom, and she was one of the characters in the movie. And I met with her shortly after Sergei Magnitsky was murdered, and we talked about how they ended apartheid. And she said it was all about disinvestment. It was all about the U.S. and Western Europe disinvesting from South Africa, that when they became financially isolated, that's when it became too much. And so I think this is really, really important. And I think this is probably, as I look at the next steps, what can we do next when we watch these atrocities unfold in Ukraine? I think it's just to pressure every single Western business to divest, to stop doing business, to stop supplying goods, to stop supplying services to Russia.
Right. Are the sanctions enough to send the Russian economy into a recession? And is this an objective that we should try to achieve even?
Well, if you had asked me 2 months before this whole thing had started, I would have said, let's just go after the oligarchs and leave the Russian people alone. We have got no beef with the Russian people. They didn't do anything. Most Russian people don't want this. I would say the vast majority don't want this. They don't want to send soldiers into harm's way to be killed and mangled. They don't want to have to pay 100% more for food and imports, which they're not even going to get anymore. No more imports. I think the average Russian person doesn't want this, and so I wish that we had done this before, and possibly sent Putin a message how costly this would be in a real way that he would understand it, so he wouldn't have invaded. But he has invaded, and so now we have to say, okay, what's the strategy going forward? And the strategy has to be to raise the price as high as possible, and most importantly, to just deplete Vladimir Putin of resources so that this war becomes so expensive and he just doesn't have the money because the central bank reserves are frozen, the exports are not generating any income, no more foreign direct investment at all. And so we're in a situation where he just can't afford it anymore.
I want to get to your personal background a little bit, Bill. To have a fascinating story. We talked about it a little bit with your firm and all of your trials and tribulations in Russia, investing there. After your ordeal battling the government in Russia, you became a global champion of the Magnitsky Act, which allows the U.S. and other countries to sanction foreign officials involved in human rights abuses. Validating or infuriating to see the need for such laws at a time like this?
Both, but most interestingly, so the Magnitsky Act works for human rights abusers and corrupt officials. It was passed in 2012, and it completely Putin blew his top when he saw this happen. And I mean, really, just like, I mean, in the most emotional way, he banned the adoption of Russian orphans by American families in retaliation. And the orphans that were being adopted were the sick ones, the ones who were not well. And Americans would still take these children back to America and nurse them to health, and they tended to die in the orphanages. So he's effectively sentencing orphans to death in his own country as a retaliation against the Magnitsky Act. And everybody was scratching their heads and saying, why is this guy reacting so harshly? And the reason is we can see it today, literally today, which is that this was the basis for which all of future sanctions were modeled on: asset freezes and travel bans. And every person that's now going to be sanctioned will basically be sanctioned on the basis of the Magnitsky Act. And the reason he was so upset was because he knew, he's not stupid, he knew that eventually the Magnitsky Act would come for his money. And so there's a direct line between the murder of Sergei Magnitsky, my campaign for the Magnitsky Act, the sanctions that were put in place, and the sanctions that are now going to go after Putin's money.
In 2018, Putin mentioned you by name during a press conference with then President Trump, offering to allow U.S. investigators to interview 12 Russian intelligence agents identified by Robert Mueller's probe in exchange for allowing Russian intelligence to question you and others close to you. Trump later called it an incredible offer. What is your view of the way Trump reset U.S. relations with Russia? And do you think it affects the way the world approaches Russia today?
Well, thankfully, I think that the Trump situation was an aberration. I don't think it was like a permanent damage to the relations between the United States and the rest of the world. And I don't think it certainly hurt the U.S. credibility for a short period of time. But we can see right now in the multilateral approach towards sanctioning Russia that things continue to work as they should. I mean, it's pretty horrifying, the idea that an American president would hand over me and a bunch of US government officials to Putin because Putin asked for that. I mean, it's just unbelievable, really. And it also seems pretty unbelievable. It took him 4 days to walk it back. And it was only after the Senate had a vote whether or not to hand us over. And they voted 98-0. About 20 minutes before the vote, Trump, through his press secretary, declined Putin's offer. But if Trump had been reelected, so that was during the Mueller probe. So and so he was sort of under the spotlight as far as Russia goes. If he was reelected, I wouldn't have been able to travel back to the United States because surely he would have handed me over to Putin. And so I from a personal safety standpoint, I breathed an enormous sigh of relief when he was defeated.
And final question, Bill, going forward, what sort of work do you see yourself doing, and what sort of legacy do you see yourself leaving?
Well, the legacy that I'm in the process of leaving is a legacy where Sergei Magnitsky's name is on legislation, not just in the United States, but now in 34 countries, sanctioning human rights abusers, not just in Russia, but all over the world. And so the Magnitsky Act now applies to Chinese officials involved in the genocide in Xinjiang, is involved in, it sanctions Iranians, Myanmar officials, all sorts of bad actors all over the world. And it creates a big disincentive to human rights abusers and to kleptocrats. And it also creates some redress for victims. And for me, the Sergei Magnitsky's murder is a burden of guilt that I carry with me everywhere, because he was my responsibility and he was killed in my service. And so every day that I do something to enhance his legacy and to do that in a way that potentially will offer other victims redress and save lives is sort of my project. And I, as more and more countries do this, then the next step is to have more and more countries use the Magnitsky Act against bad actors. And so Sergei Magnitsky will, from the grave and from heaven, be helping everybody else out in their terrible moments of distress.
Bill Browder, CEO of Hermitage Capital Management and head of the Global Magnitsky Justice Campaign. Thank you very much for joining us.
Thank you.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
Welcome back to Yahoo Finance Live, everyone. I'm Brad Smith alongside Brian Sozzi on this Thursday, June 2nd. Julie Hyman is out on assignment. U.S. markets 30 minutes into the trading session as the markets price in some more data on the employment front as the ADP private payrolls report that revealed 128,000 jobs added during May. That figure arrives ahead of the Bureau of Labor Statistics monthly jobs report. Let's also kick off the 10 a.m. hour with a look at the major averages here, which are pricing in even more data coming out and guidance revisions from Microsoft here. And as of right now, the Nasdaq composite just barely holding on to some gains by the hair of its chinny chin chin. Right now up by about 0.2%. Dow Jones Industrial Average, though, still in the red by about 0.4%. S&P 500 down 0.2%. Also, coming up this hour, longtime Facebook parent Meta Chief Operating Officer Sheryl Sandberg stepping down. What's next for the company as the tech behemoth sets its vision on making the metaverse a reality? Plus, Terra hasn't made the crypto winter any more bearable. Messari warned last year of the algorithmic stablecoin model. With the largest cryptocurrency by market cap, Bitcoin hovering near its 52-week lows, we'll get the outlook for the pathway ahead from the CEO of crypto economy data company Messari. And enter the Kentucky Fried Jack. You won't find the latest collab with Jack Harlow on a streaming service, but you may see it on a drive-through menu. In the latest fast food duo, the musical artist is teaming up with KFC. Yeah, we've got more on that later on in the hour. Let's get to Yahoo Finance's own Inez Ferre over at the Wi-Fi Interactive. Inez, great to have you here with us this morning. What are we seeing so far in the
Great to see you, Brad. We're taking a look at the Nasdaq 100 since you mentioned the Nasdaq up by its chin hair there. We are taking a look right now at Microsoft, down 2% after Microsoft revised down its fourth quarter outlook. Taking a look also at some of the gainers, though, with the Nasdaq. We are seeing Tesla up more than 2%. In fact, I'm going to pull this up so you can see a little bit with a clearer picture. Some of the laggards right now being Moderna, Gilead, some of the vaccine makers, and some of the healthcare stocks there. But we are seeing some of the gainers being Amelie, CrowdStrike, DocuSign. In fact, if we pull up ARC, we're seeing, look at this, quite a bit of green for the components in ARC. We are also looking at the meme stocks right now. We're watching GameStop after its quarterly results and that very, very brief earnings call yesterday, up more than 1%. And I just want to mention what's happening with oil because we just had some headlines coming out of OPEC Plus increasing its monthly hike by surprising the markets by 50% for July and August. So despite those increases, we know that OPEC Plus has struggled really to meet its targets, though. So we are watching WTI trading just above $116 a barrel, Brent crude also just around $117 a barrel, guys.
Nesfere, thanks so much. All right, Meta is the hottest ticker on the Yahoo Finance platform. Our news of Sheryl Sandberg stepping down as COO. Let's dive into what this departure means to Meta's outlook. Jefferies analyst Brent Thill joins us now. Brent, good to see you as always. So lots of different paths you could take here, and perhaps one way to maybe look at it if you're an investor in here, this company is now going to shift major focus and resources to the metaverse. Well, the problem is the metaverse is not making any money, and it's really hard to define. How do you take it?
Yeah, look, the Sheryl news is obviously a blow given her commitment, but I think they have a clear leader who stepped in, has been there and run multiple aspects of the business. So we don't feel uncomfortable about that, but definitely a blow to the story in the interim. I think from the metaverse perspective, I don't believe that's the case. I think there's an optical illusion that everyone's created that they're going after the metaverse when the reality is the next, call it next 3+ years are going to be all ad driven. There's no real new substitute revenue stream that's going to come in. So if you think about other stories, we talked about the analogy of Microsoft when they were the operating system company and they had to build Azure, which was their cloud infrastructure platform or the applications. Companies go through pit stops, and we think this is a pit stop that they do need to look for another revenue engine. They need to diversify the story, but make no mistake, the majority of their revenue is going to come from advertising for a long, long, long time. And they happen to have the best targeting engine on the planet to find our interests and go after us. And that's why there's so many advertisers that want to be on the platform, because they have, number one, the biggest reach on the planet of the number of users. And number two, they have the most sophisticated targeting engine. All you have to do is pull up Instagram and type in a few things and you'll instantly find how good it is. And so that's going to drive the story in the interim. Yes, they're putting money in the next generation of the internet. Yes, they're putting money into Oculus, and can they make money on this? We'll see. But I think that this concern and fear that they're going to blow all this cash because they're going after the metaverse is completely overdone, in my opinion, because at the end of the day, right, it's still an ad-driven model. And we do think they're looking for a diversification engine, and they need to do more. And good for them to make the change and get the company on the right course to find that. But I don't think that they're out of energy or speed or excitement from the advertising community. Yeah, you've had some blows from the Apple privacy change. Yes, you've seen some macro headwinds on advertisers, and we're concerned about the overall advertising market with the Snap negative what the Google comp, the Facebook comp, which are all difficult, right? Coming out of the pandemic. So we're going through that. And I think that's the biggest issue facing the global advertising industry, is really just the macro slowdown, not the move to the metaverse.
Hey, Brent, if I could take a step back for just a hot second here, considering the time period that Sheryl Sandberg was at Facebook and for the era that they were this advertising behemoth and the operations that for many of the cases being looked at as the adult in the room, if you will, that she had to make sure that this company was growing up and growing up quickly. When you think about her era, her time, how will she be remembered, considering everything from the growth of their revenue all the way to some of the Cambridge Analytica data scandals, and even to, let's be quite frank, the representation that she brought in the form of a woman at the head of a major Silicon Valley company, and where the broader industry still needs to make strides?
I mean, there's no question she had a massive impact. I mean, I think ultimately every company and every individual along the way is going to have some downticks. And, some of the things that you mentioned were clearly not a direct reflection of her, but, at her time. But I think ultimately she's going to be remembered as someone that made a huge impact, and clearly for female executives helped led the way. And I think ultimately you're seeing this now. A lot of the tech companies are still massively underrepresented, in their top ranks with females. And obviously the tech industry is trying to change that. Look, I think ultimately the individual that's coming in to replace her has incredible experience running, the company's international growth products, number of initiatives. So they didn't just pluck someone off the street that just came out of college. I mean, you have an individual now that's been in the company well over a decade and run multiple initiatives, including building the entire international business out for them. So I think, if you look at the issues separate, this is no question a blow, and she has had a massive impact, and there will be a massive hole left by her departure. But ultimately, I do think that this is one individual, and they've got a talented bench, and they prove that they've got individuals that have been there for a long, long time that know the company, know multiple aspects of the business, and can step in and lead. So I don't believe that this is going to be a massive issue. I think you're seeing that in the stock. The stock has not negatively reacted in a big way that many would think, given her departure. But look, she put in an incredible amount of time, incredible experience, and is had a massive impact on the company. So I think we'll see what ends up in terms of the next chapter. I'm sure she'll go on to do phenomenal things. But I don't believe, again, having covered tech for 2 decades, the quick reaction is when someone like this of this caliber leaves that something's massively wrong. I don't necessarily, I'm not drawing that. I'm drawing the line of, hey, this looks more like Adobe, Microsoft, other great tech companies that merely take a pit stop and are changing the tires and washing the windshield, and they're going to get back on the road. How long it takes to get them back on the road, is, again, the macro is coming in. The first thing that companies cut in a downturn is the macro, is advertising.
Brent, you mentioned, you brought up a good point on terms of female leadership. Now, out of all the tech companies you cover, is there someone or a group of leaders that might take that leadership baton away from Sheryl Sandberg, that they can step up here and drive a lot of the key messages that she has been driving?
Absolutely. So there's 2 software CEOs in software named Amy Hood, Amy Weaver. Amy Hood at Microsoft. I've worked with Amy Hood for well over a decade, and I have incredible respect. She is, in my opinion, the single most important female exec out there right now in tech. And I'd say, obviously, close number 2 would be Amy Weaver at Salesforce.com. Not a traditional CFO, but came through the legal community. And again, everyone inside Salesforce.com knows that when Amy snaps her fingers, she can herd cats from Minnesota, New Jersey, and Florida into a room in California in 2 seconds. She commands incredible respect and is an incredible leader. So I'd say right now, those are the 2 that come to mind. There are others, and apologize for leaving the others out, but I'd say those are the 2 that really come to mind on the top of my list.
Just quickly, kind of pivoting back to Meta, as we know that the ticker symbol is going to change soon, how quickly does the revenue model also change now that you have some of the executive, not just shake-up, but more so the executive kind of changeover here and the reprioritization of where that revenue is being driven that is clearly in line here at Facebook?
It's a glacial change. It's, as I said earlier, the advertising model is going to be here for a long time. So if anyone's looking for a massive inflection, the metaverse and all these creatures roaming in this new world and in goggles and whatever else you want to call it, it's going to take forever. So it's really an ad-driven model. And I think what they're trying to do, again, is what Microsoft, Adobe, other great tech companies did, was find another revenue engine beyond just the core, right? Oracle did this way back when. They were a database company, and then they moved into applications, right? Microsoft was the operating system company and then went into cloud infrastructure with Azure. They went into gaming. They went into other areas to diversify. So it took those companies, years, if not decades, to build some of these new businesses. Adobe with the Experience Cloud. They were the Creative Cloud. Then they acquired their way into the Experience Cloud, which is one of the 3 main clouds they have. So again, the analogy is it's going to take a long time. They can do it. We believe that, again, they have the user base. Yes, TikTok is a threat for the younger audience, and my kids are not on Facebook. They're on TikTok. Yes, Snap is a threat. There are other gaming stories where you may end up going to the metaverse in other ways through other platforms than Facebook going forward. So there's clearly a lot of risks ahead. But again, I think when you think about the company and what they've done, even with Reels, they were way behind in what was happening with TikTok. And I think there's signs that they're starting to catch up and show more progress in a product like Reels. So, never count them out. And ultimately, I think, again, this is going to take a long time to figure out the revenue source from the metaverse. Yeah, they're plowing billions of dollars into it, but I think it's the right call because they need to make the move and try to diversify. And so that's the risk. This diversification move may not pay off. I think it will, but it's going to take time to actually show that. And the market doesn't like uncertainty. And so a lot of investors are sitting out saying, well, I'll wait to see the signs of the metaverse come. But again, I don't think you need to look at that. I think you look at the advertising business, and that's the single biggest driver.
Brent, before we let you go, I caught a good note from you where you were crunching the numbers on the dating stocks, so Match, Bumble. Are companies like that recession-proof?
There's no recession in love. You need shelter, food, and love. And I think, in times like this, you kind of realize like the consumer's been going so hot and heavy with buying second homes. And, you look at what's going on at the core, right? You need the community around you. You need friends and your family, and you need love. And I think that we've said this, that, our headquarters in New York, there's a restaurant across the street. There's a margarita called the Mother of Dragons that's $30 for one margarita. The cost of a dating app is $15 to $30 a month, right? So like I look at that and I'm like, okay, it's incredible the value that daters get for what they pay. And again, I'm a 20-year married guy with 3 kids, so I'm not using these apps, full disclosure, but I talk to my friends that are single and other colleagues that are single that use it. And I think there's incredible value in what these companies have. I think they have incredible pricing power. I think they will be more recession-proof because you go back to the core. Are you going to take the expensive trip to Asia, or are you going to spend $15 to $20 to ensure the basics, the things that you need when things are tough? So no one's immune in tech, that's for sure. From the macro heads, the storms that are coming in on the macro side. But I think that, Bumble with their female first app, and they can diversify to this incredible $30 trillion spend for females. And that's a really big opportunity. And I really believe in what Whitney, the CEO, is doing and her vision long term. It's not happening short term, but they can unlock this female spending power. And then look at Match, global brand from 18 years old to over 50 for the old fogies can date. They have an app for every lifestyle. They have an app for every geographic region in Japan, in Europe, the US. They're incredibly well diversified, and a new leader coming in at Match from Zynga. So we'll see what he can do. But we like both stories, and we think again they're more recession proof than others. But again, no one's immune. But we like both those names right here.
Well, Brent, we here at Yahoo Finance, we love you. We love your analysis. Sending you a digital hug through the metaverse right now. Jefferies analyst Brent Thill, always good to see you.
Thanks.
All right, before we head to break, I'm on double stock watch today after 2 key momentum names got slammed on Wednesday. First is Affirm, with shares plunging 14% on Wednesday as rival Klarna's challenges persist in a very public forum. Shares of Affirm rallying back today, up about 8%. Meanwhile, Coinbase shares are also in focus as the stock got drilled by 12% on Wednesday. Amid a pullback in Bitcoin prices, shares are still about 22% away from their May lows and are down 73% year to date. Coinbase shares catching a bid so far today, up about 3%. Coming up, one of the ugliest electric cars in the EV game is getting a price cut. Brad is back with more on that and other top headlines you need to know next.
Some shock for the Chevy Bolt here. General Motors announced this week that it is slashing the prices of its 2023 Chevy Bolt. The automaker knocked $5,900 off the EV to a starting price of $26,595 and $6,300 off the larger EUV model to $28,195. So the price cut, it comes as a surprise as EV makers including Tesla, Rivian, Lucid, and even GM's own Cadillac have raised prices in response to rising commodity costs, specifically key materials needed for EV batteries. And the Biden administration is forgiving the student debt of another nearly 600,000 borrowers here. The Department of Education announced Wednesday that it will be canceling all the outstanding student loans for those who attended schools operated by Corinthian colleges, formerly one of the largest for-profit colleges in the country. Now, the companies in the U.S. here, they face lawsuits from the Consumer Financial Protection Bureau and Vice President Harris when she served as an attorney general in California for predatory and unlawful practices. About 560,000 borrowers will benefit from this latest round of debt cancellation, totaling around $5.8 billion, the largest single forgiveness action taken by the government to date. And 3 cheers for Queen Elizabeth II. Great Britain is celebrating the Queen's Platinum Jubilee, meaning she has spent 70 years on the throne. Coronated in 1953, Elizabeth's reign has spanned nearly the entirety of the post-World War II era. She has ruled during a plethora of historical milestones, from Beatlemania to Brexit, and alongside prime ministers from Winston Churchill to Boris Johnson. The festivities began this morning with a royal gun salute from the 104th Regiment of the British Army at Roldal Place in Cardiff Bay, Wales. Saz?
All right, that is cool to see. Okay, short sellers have been making power moves during the market downturn. Yahoo Finance's Alexandra Semenova and Jared Blickery have been tracking this one for us. Hey, Jared, there you are. I thought I saw you at the New York Stock Exchange.
I love to switch venues. I'm going to go upstairs. I'm going to be in the flash room pretty soon. But we are here today to talk about retail stocks, consumer discretionary. This is a beaten down sector, but it has gotten a little bit of a lift off the ground recently, Alex.
Yeah, Jared, short sellers scaled back their bets against consumer discretionary stocks last month in a sign that the hard-hit sector may have found a bottom. That's according to new data from S&P Global Market Intelligence. Consumer discretionary was the top shorted sector during the month of April, with short interest rising steadily since November. Let's take a look at performance here.
Whoops. I think this thing has a mind of its own. If we could get the Wi-Fi interactive back in this screen behind us, we'll be able to, there we go.
There we go, we're back.
Let's pull up the chart here. Okay, so this is the intraday price action, not telling us much, but what time frame are you looking at?
Worth looking at the 1-year period here. So that uptick in short interest came starting in November. As you can see, the sector steadily falling in November from its high. So you could see that performance falling more than 30% before a slight rebound last week. Now let's take a look at the 5-day period as well. You can see there's a bit of a liftoff here. On Friday, the sector rallied 9%, leading the S&P 500 in that comeback that we saw last week, still holding some of that momentum, but still well off of its highs.
Well off of the highs. Let's take a look at the retail sector heat map so we can get an idea of what's going on today. And it looks like Amazon down, that's a kahuna, down about 0.5%. So is Walmart, seeing some action from Shopify, that's up 4%. I was down 3% yesterday, but what are you noticing here?
Costco and Nike seeing some nice action here. Costco up 1%, Nike up nearly 1% as well.
All right, let's get a year-to-date look because I think we can take a look at some of the carnage that has gone on in this sector. Now, here you see Amazon down 27.5%. You can pull up a 1-year chart on this and look at this. It kind of fell off a cliff here. You take a look at the 3-year chart, and it's been going sideways, and now it's at potential support back to this 2100 level. Anything standing out to you, Alex?
Just the continued pressure in this area of the market, of course, getting worse after we saw some of those retail reports last week that indicated companies were slashing their outlooks and are starting to feel the crunch from inflation.
All right, well, we're going to kick it back to you guys.
All right, good stuff. Jared Blickery, Alexandra Semenova. Good stuff indeed. Let's get a quick check of the markets here right now, sponsored by our friends over at FlexShares. We're seeing all 3 major indices in the red, of course. Stocks are under pressure after that Microsoft warning. Worth noting, though, the Russell 2000 slightly in the green, but all eyes on that warning from Microsoft and what it may signal for many other tech companies and many other large companies over the next few weeks. Okay, coming up, Pfizer is making a push to get its COVID-19 vaccine into the arms of children ages 6 months to 5 years. We're back with more next. Pfizer is making a push to get its COVID-19 vaccine into the arms of children ages 6 months to 5 years old. Yahoo Finance senior healthcare reporter Anjali Kamani has the details. Anjali.
That's right, Brian. And we know that last week or a week before, we knew that the data came in from Pfizer, but now they actually have the fully filing submitted to the FDA. And now we're going to wait until mid-June, of course, that June 15th date, where Pfizer and Moderna are going to get a chance to get in front of that FDA advisory committee and get their data heard and just, hash out the details and see really if both or just one make it through. We know that the difference, as you can see on your screen, the data from Pfizer, they said they had an 80% efficacy for symptomatic cases, and that is based on 3 doses of their vaccine. Meanwhile, Moderna only looking at 2 doses and sticking to, despite lower efficacy numbers that we saw in those 2 separate cohorts that make up that under 5, under 6 category. So really a lot to look at right now, and that committee is really going to have a lot to wade through when it comes to this data for those younger kids. But of course, we know that is the last remaining population, of course, that doesn't have a vaccine. So definitely have to wait and see what those details end up being.
Okay, so we know that these authorizations have moved forward either for a request for the approval or just by getting more data. But at this point in time, moving forward, when we think about when government subsidies stop for the purchases, what happens for people after that?
Well, that has been the question, right? We know that, of course, that is on the table when it comes to Congress and a lot going on when it comes to what happens after. Will insurers continue to take that on? Will people be on the hook for that? And we know that's probably not going to be as popular. So obviously still a wait and see situation there.
All right. Yahoo Finance's own Anjali Kamani, healthcare reporter, joining us here to break this all down. Appreciate it, Anjali. All right, guys, and coming up, Bitcoin is hovering around 52-week lows. We're going to chat outlook for cryptocurrencies and the stablecoin scandal. That's coming up next. Is there more pain in store for crypto? Bitcoin is down right now by nearly 5% and has been fluctuating wildly this morning between 29,000 and 30,000. Other cryptocurrencies like Ether and Cardano faring worse, with investors still smarting from the pain investors saw over the last month. Most are wondering whether crypto winter will get worse. Joining us now, we've got Ryan Selkis, who is the Messari CEO, and we've got Yahoo Finance's own David Hollerith as well joining for the conversation. Ryan, first and foremost, we just got to know your perspective on the algorithmic stablecoin debacle that has taken place, that is Luna, Terra, and ultimately what that does for the sentiment more broadly around crypto.
Yeah, I mean, Terra was a unique example. It was very unfortunate. I think it's a black eye for the industry, and it's something that regulators and policymakers will latch onto, unfortunately. It doesn't change the reality of the broader crypto market and its relative strength in terms of from a cycle to cycle basis. So obviously, we've seen some pain, not just within crypto, but within all risk assets since the Fed started raising interest rates. Crypto certainly has not been spared as one of the riskiest assets, one of the asset classes furthest out on the risk spectrum. But I think with Terra in particular, it's important to keep in mind that this is one experimental currency that got way too big, way too fast, arguably. And it is not necessarily an indictment of the rest of the stablecoin ecosystem, or certainly not the rest of the crypto ecosystem. Stablecoins are still one of the killer apps of crypto. The fast settlement, the transaction volumes that we've seen that have rivaled Visa in the last year. When you look at stablecoin transactions on Ethereum, for instance, it's pretty incredible the growth that we've seen cycle over cycle. We've had the luxury of being in a 12-year, 13-year bull market in general in the economy. And within crypto, this is kind of par for the course. We've gone in 4-year cycles for basically that entire duration. So this is not really something that's too alarming for those of us that have been around the industry for a while. It is something to keep an eye on, and I'm sure that we'll see some other projects struggle. But the industry in general, when it comes to human capital, when it comes to financial capital and venture capital, has been invested in some of this infrastructure. It's never been in a more solid position than it is today.
Yeah. Hey, Ryan. Thanks for coming on the show. I wanted to get back to sort of Terra, just kind of looking at that model. I know that you sort of published some insight into maybe the bear case for Terra early on, I guess the end of last year. And, people, when they're financially invested in this, come out of the gate with a lot of different opinions. And the concept of whether or not there was any sort of fraud involved in the project, I think, is brought up plenty of times, plenty of rumors about that. And I was curious, what your inclinations were there. And basically, if you could sort of, allude to that or maybe dispel that.
I don't want to comment definitively either way, because I certainly haven't seen any evidence of fraud. I do think that this is Icarus flying too close to the sun. The project got extremely large, extremely quickly. The total kind of assets that were being borrowed against the Luna crypto token in order to create these stable coins exploded from under $1 billion into the near $20 billion threshold in a matter of months. And if you look at the history of the project before then, it actually had a really interesting fundamental usage in Korea in particular that was backing this entire ecosystem and the stable coin Terra USD. So, more recently, things got overheated. A lot of venture capitalists, plowed a ton of money into the ecosystem, and I think threw gasoline on a fire that was already burning. And then we saw what happens when reflexivity works the other way around, and unfortunately it unwound, and a lot of people got hurt. So I do think it's a teachable moment. It's certainly something that's the industry is going to have to do a better job of in terms of disclosures, particularly around the centralized players that are major holders, proponents, and advocates for these projects, whether that's the central foundations, whether that's the percentage of these tokens like we see in the public equity markets. There are some analogs that we should pull from securities regulation, even if we're not actually treating all of these crypto assets as securities, just for the safety and really the long-term health of the ecosystem.
And Ryan, shortly after the Terra USD started to sort of collapse, you published a Bill of Rights for crypto users, and it was more of a proposal, but could you sort of explain that and sort of the timing?
Mm-hmm. Well, I think we don't want the baby to be thrown out with the bathwater, and some regulators and policymakers that are a little bit more hostile to the industry right now are basically looking for any excuse to pull crypto under a very tight regulatory regime. Many of the folks that are working in policy right now on the crypto side are the groups that are backed by corporate entities. And my point in the post was one of the groups that's left out here is the end user. So we need to make sure that when it comes to the ability to self-custody assets and kind of own a personal wallet, or when it comes to the ability to actually use a decentralized finance protocol, that those rights are not limited in any way, shape, or form by new policy that gets enacted in the U.S. or anywhere in the West, et cetera. And this really comes down to constitutional protections, First Amendment, code of speech, Fourth Amendment, no unreasonable search and seizures. And I do think that some of these things will ultimately be adjudicated in court, because you will see more aggressive policies get enacted that really kind of push the envelope, push the line here, and try to bring these decentralized protocols under a more centralized hierarchical regulatory regime. That's inevitably going to lead to some conflicts. On the one hand, because policymakers want to protect people from another Terra. On the other hand, the crypto proponents, myself included, arguing that this is a natural part of the evolution of any new technology. It's unfortunate. We need to do a better job within the industry and helping protect newcomers especially. But you need to allow projects to fail, right? Capitalist systems have failures and they have successes. And I think we've gone way too long personally speaking, as a country where we've propped up zombie corporations and entities that just have not been allowed to fail. And it's created a lot of deadwood in the system. And that's one of the problems that we're going to be facing, not just within crypto, but within the broader economy the next couple of years. So a little bit of temperance is in order versus reactive policy for one catastrophic collapse of a single asset.
Right. Ryan, pleasure to have you here with us this morning. We got to leave things there for right now. That's Ryan Selkis, who's the Messari CEO, as well as David Hollerith, Yahoo Finance's own, joining us for the conversation. And everyone, coming up on the other side of this short break, KFC flying first class with rapper Jack Harlow. The rapper joins the chain to launch a Kentucky Fried partnership. More on that coming up.
Another day, another fast food and celebrity partnership. KFC is partnering with rapper Jack Harlow for a new meal called, of course, the Jack Harlow meal. Yahoo Finance's Alexandra Canal has the details on this one. And Ali, I'm going to try to do the Jack Harlow when I ask you this question. There's nothing different. There's nothing different about this menu. It's just they took a combo menu, put it together, and slapped his name on it.
Exactly, Saz. And this is a partnership that was first struck in December. So this is a continuation of that partnership. Now, Jack Harlow is a Kentucky native. He's from Louisville. He loves KFC. So he basically handpicked a lot of these menu items, as you mentioned. We got a spicy chicken sandwich. We got mac and cheese, secret recipe fries, a side of ranch, very important, and a lemonade. So he really wanted to combo some of the newer items that KFC has introduced over the past few years, like the spicy chicken sandwich, along with those classics like the mac and cheese. But this comes as a lot of these fast food brands are leaning into celebrity partnerships. Of course, we know McDonald's, they're known for their Famous Orders campaign. They've partnered with celebrities like BTS, Travis Scott, Saweetie. We have Burger King with their own iteration called the Keep It Real meals. They're targeting celebs with stage names like Nelly, Lil Huddy, who's a TikTok star. And then, of course, we got Meg Thee Stallion, Popeyes, Lil Nas X, Taco Bell, and the list goes on and on. So this is really...
Lil Huddy?
Lil Huddy.
Top of your playlist.
Lil Huddy.
Lil Huddy. He's a TikTok star.
Oh, I'm so old.
But that's the whole point. They really want to attract these younger types of consumers, and it's sort of a follow the leader approach. McDonald's did it first. It worked for them. They've cited in several earnings reports that their Famous Orders campaign led to an increase of growth, an increase in sales. So I don't think this is going to slow down.
Bro, you didn't know who Lil Huddy was.
I didn't. They need a fabulous partnership from me and Sazi. That was the playlist this morning before the show.
He was dating Charlie D'Amelio. So, there's like a whole TikTok universe. I don't think they're still together. I don't know. I'm not totally in the TikTok world, but...
Those creation houses. That's the collaboration.
It's a Gen Z. They love these things.
I mean, and of course, there was the one we were talking about the other day with Taco Bell and the new pizza that they were doing, that they were going to do a partnership with, who was it, Dua Lipa? Or not Dua Lipa, Doja Cat.
Doja Cat and Dolly Parton were going to do the musical, and they had to pull that. They had to pull the Mexican pizzas because they were overselling them. So, we're seeing a lot of this happen these days. And of course, they have that continued partnership with Lil Nas X. He's the chief impact officer or something.
I need my own partnership. I got to drop my guy over at
you should.
Papa John's.
The amount of times you talk about fast food chains.
I want the Big Saz promo deal from Rob Lynch over at Papa John's. He's a CEO.
You're an influencer in the finance world.
Give me a 30-inch, one-slice piece of cheese pizza with a large bottle of water so I could take pictures of Instagram and just blow up over it.
There you go. That's the Saz meal.
The Big Saz, the big piece, one-slice pizza.
Saz.
Yeah.
I love it.
Stick around. I think you're going to want to stick around for this one as well. We're continuing to talk the eats. Drinking coffee is apparently really good for you, and this is great for Sazi. A new study that shows that coffee lengthens your life, reduces risks of dementia, and boosts your mood. It is no surprise at all. That's where you find Sazi's take. Sazi, you drink a fair bit of coffee.
Yeah, I think Lil Huddy drinks a lot of coffee too. So we're going to be, whoever that is, we're going to be living for the next 450 years. But a good couple new surveys out. One from the Annals of Internal Medicine. That survey is saying if you drink 1.5 to 3.5 cups a day, even with sugar, which is interesting, you were 29% to 31% less likely to die than non-drinkers. So you will live longer, at least according to this survey, if you drink a good amount of coffee. And another one from the JAMA Internal Medicine Group. They are saying they looked at people, and there I am. And that is my coffee order. That is a live picture of my coffee this morning. Now that is 31 ounces of coffie that cost me $8.80, right? $8.80 pre-tax from Starbucks. Now, if you can guess how many ounces, what else is in that drink, I'll send you a Yahoo Finance hat. So please tweet me your replies. But look, this other study, they looked at folks that drink 1 cup of coffee a day, other people who drank 8 cups of coffee a day, which is really...
Where are you in that range?
I'm more closer to like 14. We'll take that off. We'll take that offline. But both of those groups have a lower risk of death versus non-drinkers, and it's very interesting. Now, you see studies like this. I've seen tons of these through the years. Your first thought, if you're up there trading on the Yahoo Finance platform, whatever you're inclined to do in your morning, only go out and buy some of these coffee stocks. Well, they've all been hit. Of course, we talked to Deutsche CEO a couple weeks ago. Its stock declined, I believe, 37% on its earnings day. Krispy Kreme donut, really, that is the only coffee stock that has been taking on or has been gaining of late. McDonald's shares under pressure. All of these companies, at the end of the day, are fast food chains dealing with labor pressures, the inability to find labor for their workforce, and the inability to push through higher prices for lots of these items. Hence, even though coffee might be good for your health, they still have to sell a lot of other things on these menus to drive sales and profits.
Well, Krispy Kreme introduces a new donut every other week, so perhaps that's what's driving people back in there. And when you think about the number of these chains that, yes, on the labor front, it is highly competitive for them, just being able to retain employees, having people show up for work, and then what the payment is quite frankly looking like as well. I mean, that's highly competitive, but again, it's just going to come down to supply chain, to being able to get enough of the ingredients that you need for a day in, day out basis.
Can we show that picture? I want to show that picture of my coffee again. Can you guys guess how many ounces that was?
Oh, it was easily 20.
32?
That's a 30.
31. That is the Trenta size. Yay. That is the largest size cup you can get at Starbucks. You're getting the hat. You're going to get the hat.
Thank you. And you know what? I was going to talk about the return of the office because I do think I've ordered way more coffee out now that we're going into the office than I was before. I was brewing my own coffee. I felt so domestic. But I think that's a part of the reason why we're seeing some of that slowing growth there.
Yeah, no,
people aren't going to the office.
True. Breakfast has been a huge. It's usually historically a huge category, and in many respects, it is viewed as a leading indicator inside of fast food companies. Once you start to see breakfast coming back, the likes of Burger King, I know you're a fellow croissant witch fan. Once you see those sales picking up, it's actually a good economic sign.
I am a breakfast wars advocate here. That's the only thing I will advocate.
All day breakfast.
All day breakfast. Done deal.
Yep.
Thanks so much for sticking with us.
Of course.
Appreciate it, Allie. Everyone's still ahead. We're taking a big look, one last look at the markets here as we're mixed right now on the other side of this short break. The Blue Oval is bulking up its workforce. Ford Motor is adding more than 6,000 jobs as it retools factories to focus more on producing electric vehicles. The move will also help Ford build traditional gas-powered cars. Here with more, we've got Pras Subramanian. Thanks so much for joining us this morning. Help us break this down, Pras, for Ford and why they're taking this move.
So today, $3.7 billion for new jobs, that's 6,200 new hourly union jobs. They're converting 3,000 other temp workers to union jobs. This is kind of a big deal in a non-UAW negotiation cycle, kind of throwing them a bone as they invest more in the gas-powered cars as well as some electric cars. So, they announced the new Mustangs coming up, which we knew about, new Ford Ranger midsize pickup we knew about, but they're adding more production capability for the Ford Lightning and also a new Ford Pro EV van, kind of like they already have the e-Transit van, but it's more like for like commercial, lower range, probably like last mile delivery, stuff like that. So they're doing these investments today. Also on a day where they announced May sales came in a little bit below what they were last year, but to be expected given how things are with production and chip shortages, things
Remember those old school Ford Vans, Praz, the mid-'80s when you could sleep in?
The Econoline?
Oh, I always wanted those. My parents could never afford it. Those things were great. They were fun to play with in the dealership. But very important initiative, no doubt about it. But, as this push to EV comes, not just Fords, Volkswagen, all these guys, don't you just need less workers? There's less parts in these cars.
Yeah, I think that's sort of what's going on here with this investment in these new workers, converting people to in states that are union states versus the electric plants, which will be in states that are non-union states. So I think this is a way to compensate for that. But you're right, Saz. You need fewer workers to make electric motors, much more less complicated. So I think there's going to be an issue, a sort of a come to Jesus moment in a few years where what do you do with these excess workers?
Of course, this also comes with the broader kind of mindset and conversation around where there have been certain benefits that companies who engage more with the UAW, and particularly this has been Ford and GM, that have gotten more of that attention, especially from the White House as well. What does it mean for other companies like a Tesla out there too?
It's Ford, GM, and Stellantis that use UAW workers, right? All the other manufacturers work in states that are right-to-work states where they don't need to have them. So the White House is going to, rightfully so, from their point of view of their constituents, is going to support these UAW factories and the automakers. So if you're a VW or Tesla, you're kind of still on the outside looking in, but as they grow and they expand in this country, the White House has to notice, and I think they are starting to do that, trying to basically talk about these non-union companies as well.
And you like the new F-150 Lightning?
I think it's great. Yeah, I think it's a really capable product, and I think it's a win so far for them.
Well, if it has your stamp, I may go out and get one. Yahoo Finance's senior auto correspondent, Praz Subramanian. Good to see you. All right, coming up, Akiko Fujita and Brian Chung will be joined by Cecilia Rouse, chair of the Council of Economic Advisors, to chat the latest on the president's inflation fight. Let's get one more check of the markets, though, before that happens. You're seeing the Dow down almost 150 points as traders fret about that Microsoft profit and sales warning. Do not go anywhere. Yahoo Finance Live. We'll be right back.
Welcome to Yahoo Finance Live. Happy Friday Eve. I'm Brian Chung.
I thought you were going to say Friday.
No,
it's not Friday
not yet.
It is my Friday, by the way. I'm Akiko Fujita. Let's do a quick check of how the markets are right now, 90 minutes into the trading day. A bit of a split picture. We've seen the Nasdaq, the only one in the green, and there we see the S&P 500 just kind of trading pretty flat. The Dow down 118 points. We've also been watching the bond yields today on the back of disappointing private payroll numbers. We're going to get to those numbers in just a bit, but let's turn our attention to oil. Some big moves there on that front today, Brian, because we saw OPEC Plus agreeing to increase output faster than expected by roughly 650,000 barrels a day. Now, it's important to note 650,000 is not a lot when you consider that more than roughly 1 million barrels a day have been taken offline because of Russia, the conflict with Ukraine. But this is a big reversal for Saudi Arabia.
Well, it's a big reversal, and we have to keep in mind that 648,000 barrel a day announcement from OPEC Plus, one of the more boring streaming services, in my opinion, is actually more than expected. Do you get it? Plus?
We got
a joke.
Yes,
yeah, but
yes.
it was more than expected. So regardless of how you kind of cut it or slice it, that increase in supply you would hope would be better for oil prices, which have remained extremely elevated. However, we did see crude oil in both Brent and regular measures go up in the wake of that announcement. Crude oil now at about $115 a barrel. Keep in mind, very elevated and basically back up to those highs that we had seen earlier in March.
Well, and we're seeing that move because I think that the market understands that this is not going to make a huge dent when you think about the shortage that's now been created as a result of a lot of Russian oil coming offline, the Western sanctions, which could increase, or decrease output by as much as 2 to 3 million barrels a day. Now, important to note this point on Saudi Arabia, though, because there is a bit of a thawing that's happening. The fact that Saudi Arabia moved, obviously they're de facto leader of OPEC, the fact that they moved points to the fact that they are hearing the U.S. demands. Of course, there's been a lot of conversations behind the scenes. There's reports today from Bloomberg that President Biden is now considering a visit to Saudi Arabia next month. And just keep in mind, we've been talking about the supply-demand issue, and yet Saudi Arabia, at least publicly, has maintained that there's no real genuine shortage. And we've seen the shift today. So not significant when you consider.
But you do wonder if that tone might be starting to change. And again, it's very obvious if that meeting does happen between Biden and Saudi Arabia, what the goal of that meeting is going to be. But want to shift to something else that we're watching as well. And that is, of course, the news that broke yesterday afternoon regarding a big leadership change at Facebook with Chief Operating Officer Sheryl Sandberg stepping down from Meta. That's after 14 years at the company. Akiko, obviously a giant in that company, building it up to a global titan in the tech and business world. But look, her legacy also involves being a leadership icon through her book, Lean In. But at the same time, there's also kind of a shroud of criticism around her tenure there because of all the privacy, antitrust, Cambridge Analytica scandals that really engulfed the company over the past few years.
Well, and she's kind of been the face, some would say the punching bag for the company, going out there and defending, it's whether it is about their content moderation policies, whatnot, just all of that. But there's the legacy story, but there's also the question about where this leaves the company. And it comes at a really interesting time. We've seen growth moderate in a big way. They're facing a lot of competition from those like TikTok, increasingly so. And then, of course, there's the big pivot that we've seen from this company, at least a public pivot, changing their name from Facebook to Meta, doubling down on the metaverse. And there's been several reports just leading up to all this that Sheryl Sandberg wasn't necessarily, maybe not on board with that big change that Mark Zuckerberg is trying to lead.
And at the core of that question, though, is how much power did Sheryl Sandberg have in addressing a lot of those crises? And there's been a kind of an interesting narrative that's been going on about ever since essentially they brought Nick Clegg in to address some of the policy issues, whether or not that was kind of the beginning of some of the erosion of Sheryl Sandberg's power and say within the company. And you do wonder with the restructuring that's been going on, not necessarily just in the C-suite, but around this whole transformation of Facebook becoming what was once just a social media website to this grand aspiration for a large metaverse, whether or not Sheryl Sandberg's role in that company was also being shrank during that transformation. Perhaps that's the reason why she announced that she's going to be stepping down, but of course does also raise the other larger question of how much power does Mark Zuckerberg now have with her leaving the company, something worth watching.
And we should point out Javier Olivian is stepping into this role, but it's
a different
some would
role.
argue a reduced role,
Right.
because there are some things that were under Sheryl Sandberg's umbrella that aren't necessarily going to be there anymore. HR is going to be one of them. The legal team's also being placed under Mark Zuckerberg. So it's an evolved role. We're going to continue to follow that and see. We haven't seen a significant, I was going to say not a significant reaction right now, but we're seeing this is the 1 year.
Yeah.
Right.
Well, 2.6% today. But
2.6%,
yeah, I mean, look,
yeah.
this is a company that's had a tough time this year.
Let's turn our attention now to the labor market. Private sector employment decelerated in May, adding just 128,000 jobs last month. That marks the slowest pace of job growth in the pandemic recovery, and it comes as investors brace for that all-important non-farm payrolls number. Let's bring in Cecilia Rouse. She is chair of the Council of Economic Advisors. Cecilia, it's great to talk to you today. When we talk about the deceleration that we saw, at least in private payrolls, that kind of points to what we heard from the president earlier this week in that op-ed. He said specifically that the average monthly job creation could shift in the next year from current levels of 500,000 to 150,000. That would be in line with the next phase of the recovery. So what should Americans be expecting right now in terms of a slowdown?
Well, look, as you highlighted, we've had a historic recovery in the past year from the pandemic, where we've had some of the fastest job growth ever in the first year of a presidency. Unemployment has come down faster than it has at any other time since data were recorded. Labor force participation is nearly back to where it was pre-pandemic. Just today, we got unemployment insurance claims. They're the lowest that they've been since the 1970s. So we know that we've got a very strong labor market, but we also know that that is not what is consistent with a strong, stable, steadily growing economy. That when an economy has basically reached full employment and is growing steadily, that we expect to see job growth more in the 150, 200, in that range. So we know that our labor market is very strong. When the Federal Reserve considers its dual mandate of stable prices and full employment, Chair Powell has said he believes the labor market is too hot. So he would like to see the job growth slow down a little bit. But even beyond that, once inflation is under control, we would expect to see job growth to moderate. And that would be more consistent with the kind of economy that President Biden really envisions for the United States.
Cecilia, it's Brian Chung here. Are you already seeing a moderation within some subsectors of the labor market when you consider that the ADP report today, which again, different than the BLS report that we'll get tomorrow, detailed actually a contraction in non-farm private employment among smaller businesses, specifically those with only 1 to 19 employees. We saw a contraction not just in May, but in previous months as well. Is the story for small businesses very different than those for large businesses?
Well, we are going to have to wait to see. ADP does not track, one for one with the data that we get from the Bureau of Labor Statistics. We know from the JOLTS data that we saw yesterday that job vacancies remain very solid. People are still quitting jobs, which suggests that they're quitting jobs, taking better jobs. Employers are still, filling jobs at a very rapid clip. So there's always heterogeneity. There's always some difference across the labor market. We will know more tomorrow when we see the data from the Bureau of Labor Statistics.
Cecilia, it does feel like there's been a bit of a shift in tone coming from the White House. We heard the president say on inflation specifically, he respects the Fed's independence. We know that's always been the case coming from the White House. But he's also said that it's up to Congress as well. And I wonder if this messaging is essentially the White House saying, look, there's not a whole lot that we can do at this point to make an immediate impact in driving inflation down.
What the president is trying to articulate is, one, not every president has respected the independence of the Federal Reserve Board. So this president is saying he understands that the Federal Reserve has got a difficult job ahead. And he respects their independence, and he respects what they need to do and what they seek to do. So that's one. Two, the president is very focused on inflation, and he is doing what he can with the tools that he has available. But part of that, in addition to what he can do administratively, whether it's releases from the Strategic Petroleum Reserve, but importantly, his economic agenda really is about increasing economic capacity, which is how we lower these kinds of price pressures going forward. And that is what underlies his legislative agenda, for which he needs the participation of Congress. That is where he's focused on lowering prices for the items that households spend, 80% of their budgets on, whether it's healthcare, childcare, energy costs. We know we need to transition to a clean energy system. We know that we need to be, refilling the coffers of the federal government. So the president is talking about his economic agenda. Really, has been about the long-term capacity of our economy, so that we can generate the kind of growth that supports good-paying jobs for average Americans, where they are seeing increases, which they haven't seen for the last several decades. Increasing economic capacity so that we've got a very healthy economy going forward.
You mentioned energy, but I guess I'm wondering if there are other levers that the administration can pull, like, let's say, for example, tariffs. So if there is, for example, inflationary pressures coming from the tariffs that were imposed by the previous administration on Chinese goods, is that something that you would be advocating to take down to lower prices here in the United States?
The president is looking at a range of options, including strategically rolling back some of the tariffs on Chinese goods, but he wants to do so in a way that makes sense for the U.S. economy, for the U.S. consumer, for the U.S. worker, and that is also consistent with working with our allies abroad, and so it's in a strategic fashion. But absolutely, the president is considering all levers that are at his disposal in a way that makes a lot of sense for the U.S. economy.
Cecilia, real quick, why hasn't it taken this long to make a decision on tariffs? I mean, this is, some would argue, the single lever that the administration can pull. And you've said your own analysis has pointed to the fact that it could drive inflation down in some manner.
So the president has been a very busy man. We've been managing a pandemic, and now we have this war, Russia's war on Ukraine, which is a very complicated situation, and which is really responsible for the latest increases in our energy prices. And so the president wants to take a considered look at these tariffs and do so in a way that is consistent with our global position in an economic framework, that is consistent with our geopolitical strategies, and that makes a lot of sense for the U.S. economy.
Cecilia Rouse, it's great to talk to you today. Really appreciate the time, Chair of the Council of Economic Advisors. Well, time now for a market check sponsored by Flex Shares. We're now seeing green across the board here. The Nasdaq leading the gains, up more than 1%. The S&P 500 up 18, and the Dow up 11. Well, coming up on the other side, the run on stablecoin, Project Terra and Luna sent shockwaves throughout the crypto industry. One top regulator offering his thoughts. That conversation is coming up next.
Hi, everybody, and welcome into Yahoo Finance Live this Thursday, June 2nd. Sheryl Sandberg built an advertising juggernaut at Facebook over 14 years. What's next for the COO, and what's her impact on women in the tech world? We'll have insights from Axios ahead. And one of the baby formula CEOs who met with President Biden on Wednesday here with solutions to the worsening crisis. Plus, the NBA's biggest star is not in the NBA Finals, which start tonight, but LeBron James marking a major financial milestone today. We'll break down the billion-dollar business of Braun. I'm Dave Briggs here with Shauna Smith.
Well, let's kick things off here with the markets because we're seeing a little bit of momentum here in afternoon trading. The Dow now up 252 points, S&P up just over 1%. The Nasdaq is the outperformer today, up just about 2%. Now, this comes despite the warning that we got from Microsoft when it comes to their guidance. Jared Blickery has a closer look at some of these movers in the final hour. Jared.
That's right. We're sitting on some nice gains for the day. Dow's up 250 points. Show you a chart real quick of the day's price action from the lower left just about to the upper right. Nasdaq, as you said, Shauna, really the outperformer of the day. And I just want to show you a year-to-date chart because we are now in territory we haven't been since early May, and we are just climbing back up there. But as I've been saying, S&P 500 still needs to clear, 4,200? Not quite there yet. Let's take a look at the sector action where we see retail stocks, that would be consumer discretionary, XLY, that is up 2%. So is materials and communication services. Tech a little bit behind that, and industrials. All of those are outperforming. So interesting mix there. Materials, we're going to talk about the dollar in a bit and how the declining dollar today is boosting that sector. Well, you can see a lot of green here. Microsoft guided lower on its, I believe, third quarter revenue. So that stock is just about unchanged right now. But elsewhere, we are seeing a lot of green. And let's just take a look at our leaders index because we have the ARK component, the ARK ETF, that's up over 6%. IPOs doing well, Chinese stocks, solar stocks, internet stocks, gambling stocks, chip stocks. That's a lot of stocks in the green here. Do want to check out the travel sector, and we are seeing a lot of green here. Expedia, some of the bookers up nicely, 5% for them. Booking up 5% as well. Airbnb a little bit lesser, about 3.8%. And then let's take a look at some of those beaten down ARK innovation names where we can see, look at that, Path is up almost 17%, and Teladoc up 10%. So nice to see some of the green here. Oh, I did mention the futures market. So let's get to commodities. The dollar is having a big reversal day from its big up day yesterday, and some of these commodities are catching a tailwind here. Copper, HG equals up, that is up 5%. RBOB gasoline futures up 3%, not so good. Heating oil up 2%, platinum, gold, cotton. So we see a lot of green today. That's my big conclusion, guys.
Hey, man, we'll take it. That is indeed a lot of green. I am leaning back.
I thought we were about to lose you there. I was like, this is an eventful start to the show.
About to go backwards. The markets are not going backwards. For more on that, I want to bring in Jim Schmigel, SEI Chief Investment Officer. Jim, nice to see you. Jared just showed us all that green, led by the Nasdaq up more than 2%. What do you make of it?
It's a nice little relief rally here, I guess. Nice little bounce. So, yeah, very interesting. Not, great news. No headline really to attach, any spark to. Microsoft not exactly instilling confidence. The OPEC news from earlier this morning is really nothing to make of it. Really shrugging your shoulders at that, with oil up on the day, commodities broadly up on the day, as we've already mentioned. So, yeah, this is just one of those days. It's just a little bit of a relief rally. These growthier names really coming back. I mean, these are names that are down 15, 17, 20+% on the year. And, every dog has its day. And today is not that they're all dogs, but, they're having their day today.
Jim, we got some comments from Fed Vice Chair Lael Brainerd earlier today. She was on an interview on CNBC, and she said, quote, "It's very hard to see the case for the Fed to be pausing rate hikes come the fall." Is this something that, do you agree with that? And I guess how is the market prepared, or will the market potentially sell off if we don't see the Fed slow down their rate hikes?
Yeah, it's really interesting. It's a great point. I think the market has been starting to internalize the fact that, maybe we won't be on this, rocket trajectory higher on Fed funds. I agree with Brainerd's comments today. Inflation is just simply running too hot. The Fed is way too far behind the curve to even think about a pause that refreshes, if you will, at this stage of the game. We're going to see 50 in June. We're going to see 50 at the next meeting. Perhaps then we can talk a little bit about maybe downshifting to 25, just to let the 50s and let this front end load of Fed moves kind of make its way into the economy. I wouldn't be surprised if maybe we saw that, but an outright pause, the Fed is just too far behind. There's no way that they can do that at this stage of the game. They have a lot of ground to make up, and a few 50s, maybe with some 25s thereafter is on the horizon, but no pause coming this year from the Fed, not from our perspective.
Jim, Brainerd followed that up by saying the economy has a lot of momentum. Do you agree with that assessment, and where so do we see that momentum?
I think in many ways it's true. I would call it more of a tug of war. It's still at this stage we're in a little bit of a tug of war between this reflationary pulse. We're seeing a lot of that today with a lot of the travel names catching a very, very nice bid in the marketplace. But it's matched up against this kind of stagflationary environment. So are we gonna be able to make it through with the reflationary pulse going to propel the economy kind of forward and allow us to kind of get over the adjustment period necessary for higher prices? Or are we still going to be on this trajectory of really CPI reaching new highs from here, and the stagflationary environment is going to take hold, and we're going to see the economy roll over a bit? So, I think saying that the economy has a lot of strong momentum at this stage, I think she's a few months late on that. We certainly have it. The pulse is there. But at this stage, it's a bit more of a tug of war than it is a straight line in one direction.
Who wins that tug of war, Jim?
That is the $64,000 question for sure. We are not seeing recession this year. So we do think that there's enough of a reflationary pulse, that the consumer started into this year with a balance sheet in good enough shape, and corporations as well. We had a decent earnings season, but the outlooks during this earnings season, with Microsoft being a great example of that today, is what's kind of giving us pause. So I think 2022, reflationary pulse wins out. 2023 is where we think that starts getting a lot murkier.
So then, Jim, how would you advise investors to be positioned then? Because it seems like we're still going to see gains this year, although next year, maybe investors should be a little bit more conservative.
I think that's right. And we feel a little bit like a broken record today. We are focusing not necessarily on the directionality of the market. We want investors to focus more on the rotation within the market. What do I mean by that? We like the more value-oriented names. So, we think that the weakness that we've seen in the growthier parts of the economy is going to continue. We think there are opportunities for gains to be had, particularly between now and the end of the year, in those value-type names. That's energy and financials, versus the mega tech kind of names that have benefited tremendously over the last 10 years or so. So value being one, we do think that's a great reflationary play. And then quite frankly, commodities we think are a great part of a client's portfolio. It's something we've been harping on for over a year now. Yeah. We still think, interestingly, that commodities broadly are very under-owned in investor portfolios.
Well, and Jim, Jim, just drilling down into that further, though, I guess which commodities do you find most attractive right now?
So we prefer a broad mix of commodities, something like the BCOM index. It's a great index. It's we paint it with this broad brush like commodities, but there's a lot going on underneath the hood. Precious metals are about 18% of that index. Energy is about 30% of that index. You have industrial metals, 15%. There's agricultural in there. We think there's a much better approach for an investor, instead of trying to pick your spots, even with things like gold or things like oil, to take that kind of diversified view. And something like the BCOM index, a broad measure of commodities, we think is the best addition that clients can make to their portfolio right now. Get some inflation sensitivity in your portfolio.
All right, Jim Schmigel, thanks so much for joining us, SEI Chief Investment Officer. Well, coming up next, Sheryl Sandberg stepping down from her role as Meta's COO. What this means for Meta, the future of tech, also the legacy that she's leaving behind. We'll have all that for you right after the break. Longtime Facebook executive Sheryl Sandberg announcing she will step down from her role as Chief Operating Officer of Meta, marking the end of a 14-year partnership with CEO and founder Mark Zuckerberg. Now, we want to bring in Sarah Fisher, Axios's media reporter, on this. And Sarah, I want to start with a tweet that you sent out this morning saying that Sheryl Sandberg grew Meta's revenue from $272 million in 2008 when she started with the company to $118 billion in 2021, 43,000% growth. A Facebook, or a Meta, I should say, without Sandberg. How worrisome, how challenging could this potentially be for the company, given her track record?
I think it's actually more of a cultural issue. There have been so many teams and people brought in under her scope that without her there, I think there's a sense of lost leadership. But in terms of the advertising machine moving forward, what she's built at this point sort of operates without her. You know, there is a bunch of people, Marnie Levine, the chief business officer, they have a new head of ads who are continuing the momentum of the self-service ad platform, which is how Facebook makes most of its money, and continuing the momentum of advertising around new products. I think the challenge becomes Sheryl Sandberg was the person who innovated to bring advertising to mobile from desktop. And right now, Facebook is in a huge transition phase, moving from mobile phones to what they call the metaverse, you know, anything from virtual reality to augmented reality. And you need a strong leader to guide that transition over to that new medium and to monetize it. And I guess the concern is if it's not going to be Sheryl, I guess it now falls to Marnie Levine, Chief Business Officer. Is Marnie ready to take on such a huge task? And especially taking it on at a time when Facebook is under so much scrutiny. Remember, Facebook bought Instagram. You know, it bought one of its most popular mobile platforms to begin inserting ads onto mobile. They're not going to be able to acquire their way through the metaverse with a lot of the antitrust scrutiny against it. And so they're going to have to be really, really innovative and really take a lot of risks in order to make that jump.
Sarah, nice to see you. Dave Briggs here. The market reaction, a bit surprising. The stock up 5.6% with the news. Is there internal concern at Facebook about her departure? And what does her departure tell us about the direction that Facebook heads from here?
I just think it means that they're going to really double down on this idea of the metaverse. You know, I think Sheryl Sandberg is getting out at a smart time. She's getting out as the company transitions away from her bread and butter, which has been digital and mobile advertising. Internally, you know, they've set up a pretty strong structure of people that are going to take over for the things that she used to oversee. They announced a new COO yesterday who will function in a little bit of a different capacity from what Sheryl did as COO. As I mentioned, they have a new chief business officer. And so I think they're preparing this next level of execs. But I do think that there is some level of concern internally. It's just been a huge force in leadership culturally at the company for so long. For her to be transitioning out is a real signal that the company is moving into its next major phase. And that's always exciting, but also comes with huge challenges.
And Sarah, with Sheryl Sandberg's exit, of course, she has been such a champion of women in the workplace. She has said that women need to be aggressive. They need to demand a seat at the table, something that we haven't necessarily seen, or I guess isn't so common, especially in the technology industry. Talk to us just about how much she has changed the game for women in the business world and specifically in tech.
Oh, it's been massive. I think this is one of Sheryl Sandberg's most important legacies that she left behind. I mean, I focused my story on the business impact that she made, but there's many more stories to be written about the human impact that she made. You know, I think the big thing for Sheryl Sandberg is she proved that women don't have to make these binary choices between having a family and having a life and taking care of themselves and being a powerful leader in Silicon Valley. You know, up until her leadership moment, there weren't a lot of women talking about that trade-off. And she came and brought it to the forefront. She sold a New York Times bestselling book on it and Lean In. And then a few years later, she sold another book about resilience and how not just women, but people should be, you know, taking care of themselves in the wake of really, you know, bleak tragedies. And her voice has moved the conversation. She's put a lot of money into philanthropy around these types of issues. And I think she's inspired other women to speak out, women in leadership on these types of issues. So think about, you know, say what you will about Sheryl Sandberg as a business leader. I think she was a very shrewd business leader, but and her Facebook legacy, but the legacy that she's made on women in Silicon Valley and in the corporate world has been pretty significant.
Sarah, then there's the question of what's next. There are whispers about politics. She mentioned philanthropy in her statement, but some say she's eyeing Dianne Feinstein's Senate seat. Can't help but ask you, the president's 82 when he would run again, and there is no bench for the Democrats. Could she throw her name in the hat for president?
I mean, I hear the same type of rumors that you're hearing. If I had to give you my honest gut, I think Sheryl Sandberg needs a little bit of a reputation cleanse right now. She just went through being demonized at Facebook for the past 5 years. And if she wants to run for higher office, I think she needs to take some time to really figure out what are her priorities. How is she going to rebrand herself as a person who is civic minded and really focused on what's better for society? When she was managing Facebook throughout a lot of drama, one of the challenges was that her reputation became marred as somebody who put sort of profit over people. And she's not going to be able to pivot away from that reputation in time for a 2024 run. I think she'll take some time, focus on philanthropy, focus on the causes she cares about. And if one day she does want to get into government or civics, that could be a good fit, but it's not going to be in the next, I don't think in the next few years.
Well, Sarah, you mentioned reputation, so it's a perfect segue because we also want to talk to you about the Axios and Harris poll that was recently put out. You were gauging the reputation of the most valuable brands in America. And since we're talking about Facebook, about Meta, they actually were at the 97th spot. Some other big tech names like Twitter, TikTok were also towards the end of that list. When you talk about a reputation problem, I guess, what is it with Facebook, with TikTok, with Twitter? What's that common denominator, and what do they need to do to turn that around?
Yeah, it's a great question. I mean, if you look at all of tech, companies that make stuff like hardware, they're doing fine reputationally. It's the companies that are focused on software, but particularly social media and information technology that are struggling. I think there's a few reasons. One, there's a huge data privacy issue. In the past few years, with things like the Experian data breach, things like the Cambridge Analytica scandal, people are much more wary of the way that their personal data is used for advertising. And that's Facebook's business model, that's TikTok's business model, that's Twitter's. Secondly, there's been a huge sort of upheaval in the US around free speech and what that means for the future of democracy and our elections. Conservatives have particularly made this a platform heading into the midterms, and they used it as a platform in 2020 as well. And so tech companies that focus on sharing information, like a social media platform, they're really caught up in the middle of this debate in America right now because people see them as the ones making big decisions over our conversation. I think that's definitely negatively impacted their reputation because you can't please everyone, of course. And then finally, I think one of the big issues is there's this really weird reckoning right now around capitalism. For the first time, you have fringe right platforms and hosts and media figures saying that capitalism maybe needs to be revisited. And Facebook is a company that really represents the best of capitalism in some ways. They grew massive over many years. And then on the other side of the political aisle, hyper progressive lawmakers and advocates say companies like this shouldn't have so much power. They need to redistribute the wealth. Yeah. And so for those three reasons, I think massive big tech platforms like TikTok, like Facebook, they are just reputationally in a very tough spot right now.
Sarah, speaking of reputation, I'm a former CNN anchor here, so very interested about your reporting under their new leader, Chris Licht, and they have a reputation of watering down the term breaking news. What is their new leader going to do in that regard?
It's a great question. So their new leader, Chris Licht, sent out a memo to staff that Axios obtained this morning that essentially said they're going to be adding breaking news to their sort of standards guide to figure out when's the most appropriate time that you're going to use the breaking news banner on TV. And to your point, the reason they're doing that, Licht says, is because you're losing the impact of real breaking news and you're losing trust with your audience if you're not delivering news that's actually breaking when you put up that banner. And so I think you're just going to start to see them be a little bit more selective about it. And broadly speaking, I think you're going to start to see some shifts at CNN to make the network really hyper-focused on quality, center, middle-of-the-road journalism, as opposed to, any sort of perspective programming or hyperbolic and alarmist content.
Yeah, the boy who cried wolf blitzer in that case, because breaking news no longer is that. Sarah Fisher, Axios media reporter, thanks so much for joining us. Good stuff. Appreciate it. Meta now facing some big questions as the company plans to move ahead without its superstar COO Sheryl Sandberg. But her departure begs an even bigger question about women in the tech industry and more than a decade of progress in Silicon Valley. Yahoo Finance's Dan Howley here with where we go from there. And was there much progress after Sheryl Sandberg came aboard?
It's interesting, right? Because Sheryl Sandberg was obviously, or is obviously known as for her Lean In book and her foundation, pushing that women kind of making their own space in corporate America. She obviously did that very well herself at both Meta and Google, Alphabet, however you want to refer to it. But it is, it does beg the question, what impact did she have on the broader industries that we see, especially with Silicon Valley and female executives? And, really it doesn't feel as though we have seen that much growth since she came on in 2008. We actually have a graphic showing the various CEOs and CFOs, SVPs. You obviously have there Ruth Porat. She's the CFO at Google, Alphabet. Lisa Su doing an incredible job over at AMD. Amy Hood, the CFO on Microsoft. If you listen to any of the earnings calls for those companies, you'll hear them constantly. So, obviously these are big names in big, heavy-hitting positions at some of the largest companies in Silicon Valley. But the fact that you can talk about that number of women in those roles, it just doesn't feel as though they're clearly not as equally represented as men in these roles. You can look up any of their executive members pages and the men are going to outnumber the women easily each time. So, as much as she did change the perception, I think, of Silicon Valley, she still is one of the few executives that actually was female at that point.
Yeah, and it's so critical here just in terms of building the pipeline of female talent. So you have one or two people at the head or in the C-suite, but you still need people at the lower management positions or even the analyst positions of entry-level positions. Yeah. Has there been one company or a group of companies that have been the leader on the forefront of this, just in terms of either various programs that they have established at their company or different measures that they are using just in order to keep up and try to improve that statistic?
I think a lot of them say that they want to do that. And whenever there's a big hire in those positions, they will point it out. But I don't necessarily think that any one company is doing an incredible job versus others. We do, obviously, we point out the numbers that we have or the main players that we have from the big tech companies right now. But it just doesn't feel as though one company is doing an outstanding job compared to the rest of the pack. It still feels very much kind of piecemeal at this point.
It needs to start at the lower ranks. It needs to start in college, though. Degrees. We need the whole tech industry getting more women involved. Dan Howley, good to see you, my friend. Thank you. Coming up, triple play on deck. We'll tell you what's driving Ford into the stocks we're watching as we head toward the closing bell. All right, let's take a look at all three major indices at 3:28 Eastern Time on a Thursday. And a lot of green on the board, 271-point gain for the Dow. And the big leader today is the Nasdaq, up more than 2%, despite what we heard from a company coming up in our triple play. This market check is sponsored by Tastyworks.
All right, well, it's time for our triple play. And Dave was mentioning it. The Nasdaq, the leader in today's market. It's interesting because Microsoft, the tech giant here, coming out with a warning about their guidance. So the company saying that they now expect to have a fourth quarter guidance of $51.9 billion to $52.7 billion. That's down from the previous estimate range of $52 to $53 billion. A lot of this because of the stronger dollar. They also cut its earnings forecast for the quarter. The move comes after Microsoft's head of finance, Amy Hood, warned back in April that exchange rates could weigh on guidance. But Praz, the stock was initially under pressure today, off just about 2% in early trading, although it looks like investors seem to be okay with the fact that they're lowering guidance. Not that big of a headwind here, at least for the sector at large.
Yeah, the business itself is pretty good, pretty strong. Cloud obviously doing well. More of this exchange rate hit. You know, it's funny. It's a conundrum of like people afraid of inflation, but the dollar's as strong as ever, right? It's a really strange kind of conundrum there. You know, speaking of big dollars, my play today is Ford. They're spending about $3.7 billion on new hiring, new UAW auto worker hiring there. They want to support their production, not just the gas-powered cars like the brand new Mustang and a brand new mid-size Ranger, but also they want to support the production of the Ford EV Lightning F-150, as well as a brand new commercial truck. They call it this Ford Pro vehicle, probably a light-duty van of some sort. So Ford really spending big here. Again, on top of the big money, they spent on 11,000 new workers down in Kentucky and Tennessee for their EV plants down there. So Ford really upping the game here with their monetary spends here. This while they're still waiting for that return on those EVs to come up, hopefully in the next 2-3 years.
Probably helps in the contract negotiations with the UAW that are still a year away, right? Interesting, though, because when you see their sales were down in the month of May, but their market share went up because everyone else was down more. The Ford Bronco, that's kind of leading the way, huh? That car is back big time.
I mean, a lot of buzz if you can actually get your hands on one.
Can't though, right?
Did you test drive it? You did, right?
I did, and it's wonderful. It's like
but you can't get them, right?
You really can't, unless you want to pay a lot of money above sticker at a dealership. You cannot buy this truck. Still, this is why you're down 4.5% compared to last year. You know?
Yeah. Hey, that Ford F-150 Lightning, though, that's going to lead the way. You know, I love that. My play is Block today, formerly known as Square, and the stock symbol SQ. Shares popped big time today on news that Block will work with Apple to integrate Square payments with the Tap to Pay feature on iPhones, which will launch later this year. Customers would only need the Square app and their iPhone in order to accept payments, no hardware. The stock was up more than 7% at one point on the day, now up more than 5%. But when you look at the big picture, still down 70% from their 52-week high and down 46% year to date. So a long way to go.
It certainly is a long way to go. And we know that Square, or Block, I should say now, isn't the only player in the space, which has been hit hard. It's interesting when we take a look at what Apple has done, though, in the fintech space. So now they have this partnership with Block. They launched a credit card back with Goldman Sachs in 2019, I believe. There's rumors of a buy now, pay later service. So they're getting more into their services side of the business, trying to diversify. Will be interesting to see whether or not that pays off for the company.
You know, I read that headline and it's like, music to Square investors' ears to see Apple tie in right with that tap to pay. I mean, that's just a natural time, really necessary there. The stock has been so horrible this year. Really good to see that they're doing this one little nice deal with Apple. I mean, and a huge space there, right?
Yeah. We'll see whether or not the excitement sticks. All right, Pras, thanks so much for hopping on here for Triple Play. Coming up next, President Biden admitting that he did not know how serious the infant formula shortage was until recently. He's saying he didn't know about it until April. We're going to discuss right after the break. President Biden meeting with baby formula makers yesterday. And while the president said that he wasn't aware of the crisis until April, just 2 months ago, month and a half ago, other executives in the industry knew there would be problems as soon as Abbott issued its recall back in February. Here's what Robert Cleveland, he's the senior vice president of nutrition at Reckitt, had to say.
We were aware of the general impact that this would have. And so from the moment that that recall was announced, we reached out immediately to retail partners like Target, Walmart, to tell them this is what we think will happen. And this is the inventory we have on hand right now. You should order it. And any inventory in your distribution centers should be pushed to shelves as fast as possible.
All right, well, our next guest also met with the president. He was at the meeting yesterday. We want to bring in Ron Beldegren. He's the co-founder and CEO of ByHeart. Ron, it's great to see you. There is a clear disconnect, as you can see, from the timing of when the shortage was first flagged by those of you in the industry versus when President Biden was aware and then the government's response. I guess a two-part question here. Could the shortage then have been avoided? And where's the FDA in all this? How much blame should we be placing on the FDA in this situation?
Well, first of all, thanks for having me. Look, first of all, I'll say I think it's great that the administration is pulling together the various stakeholders to discuss, such a critical topic. I mean, this situation is unthinkable. I had my second baby this past weekend. So
we noticed.
We heard.
So that CEO by heart, but as a parent as well. No one should need to experience the anxiety of not having sole source nutrition for their baby. So we were grateful to be included in the conversation. As one of only 5 companies in the country that manufacture infant formula, we feel made a responsibility to be part of a sustainable solution to this problem. And as you know, 5 years ago, we made a decision, a commitment to own our entire supply chain, to take a path no new entrant has in decades, and acquire manufacturing, directly source our ingredients, conduct the largest clinical trial from a new brand in 25 years. And that was really motivated by a desire to innovate on this critically important food. But now, as you point out, we're sitting in the midst of a national crisis, and we feel validated in that approach that we can be part of that sustainable solution. To answer your question on why various stakeholders may have been surprised by this, I'll tell you why, in our view, it's been a surprise to many parents and to many people across the country. I mean, one of the biggest misconceptions in this category, and something that you don't often realize, is when you're standing in front of a crowded infant formula aisle and you see lots of different labels and lots of different brands, lots of containers, it seems as though there's lots of choice, and you would think there are dozens of companies that are supporting this most foundational food, right? But the reality is that 90% of the shelf is from just 3 brands that have dominated for 100 years. And every new entrant in the last few decades have taken the same path, to outsource to the one and only contract manufacturer in the country and utilize an expedited kind of generics path to market, which only allows for sort of incremental change based on existing recipes. So it's actually a much more fragile supply chain than I think many people realized. And that's something that we're kind of seeing now.
And Rob, you mentioned those 4 companies accounting for more than 90% of the market, but Abbott itself was more than 40% of the market prior to this crisis. What needs to change in this system? What can the government do, in your estimation, to ensure that we're never here again, that mothers are never watching their babies starve, that we're never watching airplanes fly from foreign countries airlifting formula to the United States?
Yes, look, I think it's great, first of all, that the administration is taking steps to provide near-term relief to a really urgent problem. And that's, we have babies out there without sole source of nutrition. So some of the moves that have been taken with import and other are great near-term solutions to get formula into the hands of babies. But for us to never find ourselves in this situation again, we also need some sustainable solutions. This is too fragile a supply chain. This is the United States. We can't be in a situation where one company has a recall and 40% of the country is without infant formula. And the only way to change that is to really invest in new manufacturing and bring on more diversity to the supply chain. So we became the first new manufacturer in over 15 years with our launch earlier this year. We have the most recent FDA registration. We're investing in initiatives that will collectively allow for up to 500,000 new families to get fed, even above our projections. And that's some 15% of new births. And we're very focused on building that infrastructure here in the United States. We also need to drive more incentives for other companies to do the work that we've done. The fact that all other new entrants have outsourced to a contract manufacturer means that none of the new entrants in the last 15 years have brought in incremental manufacturing or new clinical studies to continue to advance the field. And so we need more companies to set up infrastructure here, run clinical trials, and build new manufacturing and meet really the very heightened and appropriately so regulatory standards for manufacturing infant formula in this country.
Well, Ron, from your meeting with the president yesterday, I guess, are you confident that we are going to see change? And then, because we were looking at some of the statistics, 1 in 5 U.S. states is 90% out of baby formula, and this comes after some of the President Biden's initiatives started. I guess, how soon could we potentially see actual change in your industry?
Look, I think what we heard yesterday is that, I think every stakeholder involved is working tirelessly to solve this issue. It's sole source nutrition for babies is universal. No parent. This is the most anxiety provoking idea that one can imagine, to be without sole source nutrition. So I think we heard around the table, each company in this space really working to get us out of this, national crisis. I can tell you, we at By Heart are throwing everything that we have at this situation. As one of just 5 companies in this country that manufacture infant formula, we feel big responsibility and are taking that responsibility very seriously. We're investing heavily into our manufacturing in Reading, Pennsylvania, with a new $30 million investment. We are hiring aggressively. We're adding a whole new shift. We're already working 24 hours a day, 5 days a week. We're moving to 24/7. Even just within days of the enforcement discretion policy being announced, we had 2 submissions into FDA to expand our manufacturing footprint and accelerate fulfillment to get parents' formula even quicker. And all of that here in the United States to really create a hopefully sustainable solution and incremental manufacturing here at home.
That plant, the first in the U.S. in more than 15 years. Kudos to what you're doing, Ron Beldegrun, By Heart co-founder and CEO. Thank you. Coming up, the ETF report will break down investing tips and how to diversify your portfolio amid all this market volatility.
Investors are putting money to work. Global equity funds seeing money inflows last week for the first time since early April. We want to bring in Noah Hammond, Advisor Shares founder and CEO, as part of our ETF report brought to you by Invesco QQQ. Noah, it's great to see you again. Let's start with that data point, because Refinitiv Lipper was out saying that investors bought a net $6.2 billion worth of global equity funds last week. Is this the start of a larger trend? Does this give us some reason to be bullish right now?
It could. Internationally, it's struggled performance-wise for quite a long time. We've only started to run into performance challenges in the U.S. stock market, late last year and throughout the beginning of this year. So it's not surprising that flows are starting to move more globally and more internationally, especially if the Fed's going to continue with, not just, tightening relative to their balance sheet, but increasing interest rates. So that's probably not a complete surprise, even though the markets are still pretty high right now.
And Noah, on the flip side of this, because then Vanda Research was also out with data points saying that traders also bought a near record amount of bond ETFs. So from your perspective, I guess, is that signaling then some calls for concern, or maybe some calls to be a little bit more conservative?
Well, I don't know that it's calls for being more conservative. I think that's maybe some investors placing a bet that the Fed changes their mind, that it will be difficult for them to continue to increase interest rates, given still supply chain issues, obviously growing inflationary environment. But then you think of the size of the debt and the servicing of our U.S. government debt with each interest rate increase, it becomes pretty significant, and likely we'll see that ripple effect on the stock market, even though I think the Fed balance sheet drives more of that. But I would look at those bonds as suggesting that it's more people making a bet that the Fed's going to change their minds, because bonds have been down along with equities this year as well.
Well, another thing that's been down, and you're actually getting into this space, is Bitcoin and crypto. Certainly, we've seen a lot of volatility. I know you're out with a new ETF, CRYP. It's a managed Bitcoin strategy. When there's so much volatility in this space, what do investors need to know? I guess, how does this fund then account for some of that volatility?
So investors just have to have a plan, right? They got to know when they want to get in, how often they want to get in, when they want to get out, limit orders, things like that. And the challenge with Bitcoin, it is so volatile that as new investors are learning about it and learning the utility of it and the value and the usefulness of it, that volatility will scare you, right? Over the last, 6+ months, it's down roughly 50%. Most investors really don't want to participate in something where they've got to make the decision of when to get in, when to get out. And that's what's different with CRYP. We're working with Mark Yusko and the team at Morgan Creek Digital. They have experience running really is what is a trend following strategy trading in Bitcoin. But for the first time, that strategy is available in an ETF that anyone can buy via CRYP. And that's what it does. It'll use momentum and trend following to decide when to be fully invested and when to pull back from that. So for example, right now, it's sitting about only 50% invested in Bitcoin.
And Noah, so far, what has the interest been like in this space, or specifically in your ETF? Because it comes at a time when maybe crypto investors hear that word and they're trying to steer clear of it.
Yeah, it's a little bit of what we're seeing. The fund's only a month old now, but very, very small, low trading volume. I think the price probably has to turn around a little bit to pique investors' interest again. But I think when that happens and they're searching for a solution of how to get that Bitcoin exposure, they're still faced with the same decision. Buy it through Coinbase, buy the physical, buy the ETF, but all are fully invested. I don't expect the volatility is going to go away anytime soon, or find something like this that's more of a managed solution. So this is not something that people would frequently trade. It's something that if they want the exposure, it's a little bit more of a set it and forget it type of investment strategy that gets you exposure to Bitcoins via futures.
Yep. Despite all that volatility, we know a lot of investors still want to get their hands on it. So certainly a way to get into the crypto space. Noah Hammond, right. Advisor Shares founder and CEO. Thanks so much for joining us. Well, coming up next, the DOJ is investigating its first ever insider trading case involving NFTs. We're going to have the latest right after the break.
For the first time ever, the Department of Justice is pursuing an NFT insider trading case. On Wednesday, federal prosecutors in New York charged and arrested Nathaniel Chastain, a former product manager at online marketplace OpenSea. That may ultimately prove to be the tip of the iceberg in that capacity. Ali Canal here with the sea of NFT scams popping up essentially every minute, Ali, and now they're involving celebrities, or at least appear to deceive people into their celebrity involvement.
Yeah, you're right, Dave. There's so much happening with this space. We had a new report out today from Brand Shield, which is a cybersecurity firm that tracks these things. And basically, they identified 10 of the most popular celebrities that have attached their names to NFTs, crypto, digital wallets. And they found that out of those top 10, Tom Brady was the most impersonated across all of social media, nearly 3,000 impersonations, making up more than 17% of that top 10 list. You could see that following Tom are Matt Damon, Mike Tyson, Kim Kardashian, and Paris Hilton rounds out the top 5 there. So pretty crazy list. I spoke with the CEO of the company that did this report. He told me it's a wild west right now when it comes to the type of scams that are happening across the board online. Most of these impersonations are coming from Twitter, which we know has been a big issue on the platform. Elon Musk highlighted that amid his Twitter takeover, and things are only getting worse and worse.
Instagram, too. I get a lot of them on Instagram.
Oh, so many.
Personally, a lot of my friends, too, have been hacked on Instagram. So if you're a consumer, you just want to make sure that you're going to verified sites, verified accounts. You're not giving away your information too freely. There's a lot of work that goes in behind the scenes. So this is happening more and more, and it's only going to continue as these cryptocurrencies
certainly seems so prevalent already. And you talk about it could really rise in popularity. Ali Canal, thanks so much. Coming up next, we are counting down to the closing bell on Wall Street. 5 minutes to go in the trading day. Dow adding to earlier gains, now up nearly 400 points. We'll be right back. The closing bell just minutes away, and we're actually looking at some buying action into the close. Ines Frey has a closer look at this. Ines.
And Shauna, we are going to close near the highs of the session with the Nasdaq up 2.7%. That's the outperformer out of the major averages. And you've got the S&P 500 up 1.8%. The Dow gaining 417 points as we go into this final minute of trading. Taking a look at the sector action, we're looking at consumer discretionary that has led today, followed by materials, communication services, and technology. Over on the Nasdaq 100, take a look at this left-hand side of the screen, those mega caps. Alphabet up more than 3%. Amazon, part of consumer discretionary, up 3%. Tesla also up more than 5%. And Nvidia and Meta also higher. In fact, you've also even have Microsoft, which recovered from its earlier losses this morning after the company modified its outlook. It will be closing the session in green territory. Mentioning software stocks, this is our software chart. Quite a bit of green that we're seeing on the screen here. We're also checking out the semis that are seeing green across the board. And even ARC Innovation ETF holdings, look at this. You've got Shopify up more than 10%, Zoom that's higher, Spotify is also higher. And looking at the travel stocks, these are seeing green across the screen. Over on the meme stocks, we're seeing GME up more than 10%. GME had opened in the red slightly. It was up around 1% earlier in the session this morning, and you can see the gains here in the afternoon. AMC up more than 3% today. Oil today also rose despite OPEC Plus increasing its output hike and amid an inventory drop. Here's the closing bell for today. Take a listen.
And that was your closing bell, sponsored by Tastyworks. The Dow, S&P, Nasdaq, all finishing well in the green. The Dow 434-point gain, the Nasdaq up 2.7% on this Thursday. For more on the markets, let's bring in Michael Weiss, Yield Street founder and president, and Ahmad Riesco, Insignia Chief Investment Officer. Nice to see you both. Sometimes the markets are just flat out confusing. Michael, what do you make of the sea of green, in particular with the tech-heavy Nasdaq?
I think it's typical for where we are in the market. We're going to see a sea of green tomorrow and a bloodbath of red the day after. I think that we continue to see a lot of volatility in the market. Investor sentiment is poor. Global equities, fixed income, and crypto are continuing to experience turbulent times. I don't think today is an indication that sentiment is back. I don't think today is an indication that our toughest days this year are behind us.
Ahmed, what do you think? I mean, do you think we'll see a lot of volatility? How Michael put it, potential bloodbath? Are the toughest days behind us? What's your view?
Yeah, I agree with him that tactically here, the market is set up for volatility. Technically, it doesn't look great. And like he said, investor sentiment is still quite negative. But we actually think that in the medium to longer term, 6 to 12 months out, the picture actually looks a lot brighter. So I think once we weather this period of volatility, I think the outlook, especially for the second half of the year, looks very attractive in certain equity markets out there.
Michael, your notes say you thought Jamie Dimon's comments about an economic hurricane were, quote, theatrical. What do you make of Goldman President John Waldron saying the confluence of the number of shocks to the system, to me, is unprecedented?
I don't think those two comments are the same. I do think that the number of shocks to the system are unprecedented. I don't think that we are going to see a hurricane per se. I agree that I think maybe 12 to 18 months out, we're going to see a stronger market. I think the American consumer is healthier than it was even pre-crisis levels. Our banks are better capitalized, but I think we need to see some really important data points come out. The Ukrainian war needs to find a resolution. Inflation in Europe and China have to get tamed. The Chinese government held a video conference recently, I think with about 100,000 officials that are talking about, creating a plan to stabilize the economy. We need some better answers, but I do feel that the overall health of the U.S. consumer, and 12 months out from now, maybe 18 months out from now, we're going to see a stronger market. But I think right now, the investor should really be thinking about moving outside of public equities and trying to find better investment solutions to not have to deal with the volatility and to generate the right returns.
Ahmed, we got some comments this morning from Fed Vice Chair Lael Brainerd, and she went on to say that she doesn't see the case for pausing rate hikes, at least through the fall. Is this something that you think, is the economy strong enough? Will the market be able to withstand a continuous rate hike cycle?
Yeah, so I think the question we all have to ask ourselves is the Fed going to tighten more than what is already priced in? Right now, as we speak, the market is priced in a 2.8% federal Fed funds rate for the end of the year. If the Fed is going to hike to that level or below, then you will see markets rally. But if it's going to keep increasing or keep pushing that number further out, then you could see further volatility there. So I think the comments today, it's understandable that they make comments like that because they really are data dependent. I think we're going to need to see a sustained drop in key inflation indicators and figures before they can at least take their foot off the gas in terms of the hiking cycle.
So, Ahmed, you see 2 50-point hikes and then a 25, and then we'll see. Is that what you project?
Yeah, I don't think the Fed's going to have to tighten by much more than what is already priced in, which is why we sort of have that 6 to 12 month pretty sanguine outlook on U.S. equity markets. And we've actually turned pretty neutral. We've been, pretty bearish treasuries here for a while. We do think we started a long-term structural bear market in treasuries, but I think we're going to see a period of consolidation where we're more neutral on treasuries right now. And I think part of that is a sort of peak Fed hawkishness thesis that you're seeing out there, which I do think has some legs, has some credibility to it, because we are starting to see figures coming out that are pointing to inflation subsiding just as we expected in the second half of the year.
Michael, what do you think just in terms of how much of the Fed's tightening plan has already been priced into the markets?
I think there's two outlier events that are, or maybe one specific and one that I'm not sure is priced in yet. I believe there's still about $2.1 trillion of stimulus that hasn't hit the street yet. I think 950 of it is targeting municipalities and local governments. I think that we're going to see worse inflation before it gets better. I think that's number one. Number two, I am of the opinion that the 2024 elections are going to play a significant role in how this administration chooses to, maybe say influence the impact of inflation and, certain key economic issues that we have going on here. And I'm not sure that we're talking about that enough. I think if the Democrats want a chance to win, they're not going to be able to do that with this type of sentiment. And so they're going to have to do whatever it takes to bring the U.S. consumer to feel healthier about their current state of financing, their jobs, their inflation, the cost of goods. And we're not seeing that discussion happen yet.
A change of power looking awfully likely at this juncture. Ahmed, do you agree with that assessment that inflation could get worse before it gets better? Most are pointing to some signs that they think it's peaked.
I mean, it's possible, obviously, but we don't think it's likely. In fact, the sort of data that we're looking at already shows us that we are, if not at peak inflation, we're very near that peak. We've seen sort of second and third derivative numbers and figures that we follow showing us that there has been a deceleration. There even has been a deceleration in wage gains, which is good to see in terms of the overall inflation picture. Remember, it's very difficult to get a sustained inflationary uptick without wages really driving that. And we're starting to see that. So we're pretty confident in the fact that inflation is either at or very near peak, and it is going to go down. Now, let me be clear. I'm not saying that inflation is going to go back down to the levels that it was before COVID. That's not going to be the case. In fact, we think we're starting a multi-year period where inflation is going to be systemically higher than it has been over the previous 10, 20 years. But it's not going to be at these levels. Right now, we're sort of projecting inflation to end the year at somewhere between 4 and 5%. Obviously, that's much higher than the inflation that the Fed wants to target. But the point is that we're seeing these numbers coming down, and that's going to allow the Fed to take its foot off the gas. Keep this in mind. A lot of tightening of financial conditions has already occurred. In fact, the Fed has tightened financial conditions just as quickly as it loosened conditions during the pandemic. That is an extraordinary amount of tightening. Remember, tightening just does not occur from Fed rate hikes. It occurs from the drop in equity markets. It occurs from the widening out of credit spreads. Several things go into what are called financial conditions, and those have tightened significantly already.
There's a lot more to talk about here. Unfortunately, we're out of time, so we're going to have both of you back. But Ahmed Riesco and Michael Weiss, thanks so much for joining us today. All right, coming up, we are waiting for Lululemon earnings. They should be out any minute. We're going to take a quick break. We'll be right back. Lululemon earnings are out, and you can see a pop here in shares. The stock up just about 3.5%. Jared Blickery has that for us. Jared.
That's right. Stock has been up as much as 6%. First quarter results, net revenue was a beat, coming in at $1.6 billion. That's up 33% year over year. And you can see on your screen there, that beats the estimate on Wall Street of $1.54. And then first quarter adjusted EPS, that's $1.16, which bests the estimate of $1.43. And then inventory, that's a key number that we've been tracking across a number of industries. That is up to $1.28 billion, and that is up 32% year over year. Total location count coming in a little bit shy, about 8 stores shy of the 587 that Wall Street was expecting. First quarter total compensation, sales excluding effects, that is a key stat. That's up 29%. That's a lot of money being shelled out for executive. Same store sales up 24%. Also, they're seeing the second quarter net revenue of $1.75 to $1.78 billion. They've raised that from $1.72 billion. And full year net revenue now seeing $7.61 to $7.71. Previously, they saw 7.49 to 7.62, so they expanded that a little bit too. We want to move on to CrowdStrike because they are reporting revenue of $487.8 million. That beats the estimate of $463.9 million. First quarter adjusted EPS was 31 cents, and the estimate was 23 cents, so beating that by about 8 cents. Subscription revenue, $459.8 million. That bests the estimate of $436.8 million. Annual recurring revenue, $1.92 billion. That beats the estimate of $1.9 billion. That is a key stat for them in terms of what they are going to be able to pull in on a subscription basis. Total subscription customers, 17,945. That beats the estimate of 17,784 by a couple hundred. Total new subscription customers, 1,620 versus the estimate of 1,649, so a little bit shy there. And then they are seeing second quarter adjusted EPS at 27 cents. And the street was expecting 28 cents. So a little bit light right there. And you can see the stock is down about 2% in after hours trading, guys.
Jared Blickery there with some good numbers, some mixed numbers there. Thank you so much, my friend. Let's talk gas now. Another record high at the pump today as the average gallon of gas reaches $4.71. That's up 52 cents in just a month. But there was some good news in that regard, and that OPEC and its oil-producing allies, OPEC Plus, have agreed to hike output this summer. Yahoo Finance senior columnist Rick Newman here with more on Russian oil and how Vladimir Putin actually has a valuable weapon in oil, has nothing to do with military arsenal, but how valuable is oil to Putin?
It's crucial, and he's getting so much revenue from oil, despite all the sanctions that the United States and European nations and other nations have put on, that in April and March, they had record oil revenues. Sales are down a little bit, because the price is up, Russia is honestly just raking in cash. And of course, this means they've got plenty of money to keep the fight going in Ukraine. And this is not pinching Putin the way many nations allied with Ukraine want to do.
Rick, but so since then, though, we know that the EU is phasing in a partial ban, though, of Russian oil. I guess the question is, if EU isn't buying that oil, is that going to be a big hit for Russia down the line, or are they going to find somebody else to simply buy it?
It depends if Russia's able to find other buyers, and they probably will be able to. Just to give a quick overview, Shauna, of what we know about the sanctions so far. They've been in place for about 3 months now. They seem to be having a real serious effect on what you might call Russia's consumer economy, because they're shut off from so many overseas products and components they need, even when they build their own products. Things like car production and airplane production have practically stopped. And you almost cannot even buy a new car in Russia at this point. But in terms of the revenue that the Kremlin gets from oil and gas, which is its biggest source of revenue, as we just discussed, that money keeps coming in. So the problem here, of course, is that for this to actually have an effect, such as this European ban to actually work, it means that Russia has to be unable to sell its oil anywhere. And Russia's the third largest oil producer in the world. And if you took even half of its production off the global market, you'd see oil and gas prices skyrocket here and in Europe and all around the world, even more than they have already. So for this phased-in ban on European purchases of Russian oil to work, it almost by definition means we have to have higher oil and gas prices. So I think that's quite a worry for consumers here. I think that gas prices honestly are going to go above $5, and I don't think $6 is out of the question.
Well, helping Russia skirt these sanctions in particular is India, who's now buying 800,000 barrels of oil a day. That's compared to 30,000 prior to their invasion of the Ukraine. And some of that oil arrived in the United States just a couple of months ago. That is a big problem we have to solve. Rick Newman, thank you, sir. RH earnings are now rolling in. Ines Ferre has the breakdown. Ines, what are we seeing?
Yeah, Dave, it's a big beat on the top and the bottom line for the first quarter, with adjusted earnings per share coming in at $7.78. That came in above expectations. And net revenue also coming in above expectations. But it's the guidance that may be putting some pressure on the stock in after hours, with the company seeing an adjusted operating margin of 23% to 23.5%, and net revenue in the second quarter down 1 to 3%. Now, some interesting points that Gary Friedman, CEO of the company, said in a shareholder letter, saying that while there's been widespread return to discounting across the industry and there may be short-term risk of market share loss by choosing not to promote, we believe there is a certain long-term risk of brand erosion and model destruction once you go down that path. So the company touting that in the first quarter, adjusted operating margin reached 24.7% versus 22.6% a year ago. But then later in the letter, the company, the CEO also stating that despite our record financial performance in the first quarter, we have experienced softening demand trends, which began at the time of the Russian invasion of Ukraine and have further slowed during the market disruption over the past several months. The company had given indication of this, and now reiterating this again. That's maybe why you're seeing a little bit of pressure on the stock in after hours.
Stock off just about 4%. All right, Ines Ferre, thanks so much. Coming up next, we're going to get a deep dive into Lululemon's first quarter earnings report. Again, shares popping after hours, although now up just about 2%. A beat here on revenue. They also raised their full year revenue guidance. We're going to be back with more in just 2 minutes. Lululemon earnings are out, beating the street's estimates on revenue. You can see shares popping after hours, up just about 2.6%. The company also raising their guidance for the year. We want to bring in Adrian Yee, Barclays consumer discretionary analyst. And Adrian, it's good to see you. I know you're bullish on Lululemon. Taking a look at this report, what's your big takeaway?
Donna, good to see you. My big takeaway is this is absolutely a remarkable print. The reason I say that is because if you just think about all of the supposed COVID winners, the people who benefited during, the pandemic, clearly athleisure was one of those categories. So to come out on the other side of this after 2 years of getting some of the benefit, it is absolutely remarkable that they are one of the single frontline retailers that is actually besting their performance during the pandemic and continuing to grow.
That's really interesting. Very few companies are COVID winners and reopening winners. How were they able to so successfully make that pivot?
So it's two things. So during the pandemic, one of the things that they did is they actually acquired customers, new customers, as we all know, but they acquired them at younger and younger age ranges. If you think about the Lululemon from, say, 7-10 years ago, or even when they IPO'd, it was largely a soccer mom, right? A soccer mom that was probably in her late 30s, early 40s, and well-to-do. If you go out to any, kind of soccer game now, all the way down to these middle schoolers, high schoolers, college-aged young ladies, they're all garbed head to toe in Lululemon. So think about the lifetime value that they've stretched during this period of time. And then the second piece of it is that they are giving the customer new things to buy with her dollars. So even though she is full up on yoga wear and athleisure, they're giving her footwear, they're giving her tennis, golf, men's, and then they're building through international.
Yeah, the men's business. I know Dave is a big believer in that, and you love Lululemon.
It's my goal to wear nothing but Lululemon in life.
My goal too. I know.
It's really, I don't have many goals.
I was able to do it during the pandemic, although coming back to the studio, we got to change up the wardrobe a little bit. But Adrian, going back to a more serious topic here in regards to Lululemon, you have a price target of $450. Right now, we're trading just above $300, right around $310 a share here after hours. What's it going to take to get to $450?
It's going to take the company on its path to Power of 3 x2. They just had an analyst day, April 20th, and they laid out effectively the same goals that they had in their last 5-year plan. By the way, they reached that 5-year plan in 3 years. So they had to reset those goals. And that's to take the business from $6 billion in sales to $12 billion in sales, to double men's, to double digital, and then to quadruple their international. So they really do have to continue to be on that path. But if you think about the growth and the opportunity, both in EMEA and in Asia and Greater China, in men's, as we just said, they're kind of at the tip of the iceberg. I'll give you a quick stat here. Their $5.5 billion in North America is primarily women's, right? So there's about 25% of that is men's. But if you think about Nike's North American apparel business alone, it's about $5.5 billion. So that is a crazy rivalry where Lululemon is actually at the forefront of that contest.
Yeah, they project to double their men's sales this year alone. You mentioned the international potential, but domestically, is there a new product line in the works? What's next for Lulu here?
So for men's, it's all about kind of that, they call it the to and from, right? So for you, it'd be the ABC pant. And that line has been tremendously successful. It is something that you can take from the COVID, at work at home, and it actually does benefit from return to work. So when we're back in the office or when we're doing meetings, I would say 90% of the people we're meeting with are actually in those kind of ABC pants and then the wear to work. They are also going to be doing that type of product and starting to slowly introduce that in the women's side of the business. So that's another avenue for them to kind of increase, as I said, her share of wardrobe.
And Adrian, we're going to get the earnings call. It's expected to get underway in just a couple of minutes from now. What do you want to hear from Lululemon, from the executive team on this call?
Yeah, it's pretty phenomenal that their second quarter, right? So their second quarter, actually, they raised sales and they raised EPS. Even though their China exposure is fairly de minimis at this point, it's only low single-digit % of sales. I'm very curious to hear what is going on with their China business. Why aren't they down 40% like many of the others who have guided for that region? And I also want to hear, how are they faring through the supply chain? The two big things are going to be their inventory. Everybody's asking about inventory. And then to the extent the potentiality, right, of these promotions. I think you were just talking about RH. and talking about the promotionality of the environment. If they don't play ball, maybe they'll lose some share. Lulu does not play the promotional game. And I think that the key here is that their brand is so darn strong and they have so many new entrants to the brand that they can continue to drive the full price sale.
Very interesting. Adrienne Yee, appreciate you joining us. Thanks so much for that analysis.
Thanks for having me.
Okay, like the rest of us, restaurants across the country are facing rising inflation and forced to get creative rather than raise their food prices. Brooke DePalma is here with that story. And Brooke, we're seeing a staggering increase in hidden fees.
That's right, Dave. Additional fees may include phrases like service charge, non-cash adjustment, kitchen appreciation, fuel surcharge, that is, or wellness. Those are just some of the examples that restaurants are using to get really creative when it comes to combating higher food and labor costs. Now, when you take a look at the already implemented menu price hikes that we've seen across the nation year over year in April 2022's Consumer Price Index, we saw menu price hikes up to 7.2% year over year. Now, that's the largest one-year increase since 1981, so something that we haven't seen in nearly 3 decades. Now, I did speak to the National Restaurant Association, who, of course, is speaking to restaurant owners across the nation quite frequently, and they said in a statement to Yahoo Finance, consumers are sensitive to menu price changes, and while they still view restaurants as essential to their daily lifestyle, the current economic environment will potentially influence their spending patterns in the months ahead. Now, Hudson, who is the Senior Vice President of Research, went on to say that the typical restaurant business model is not set up to deal with these sustained and accelerated food and labor costs, which is putting extraordinary pressure on operators, and indications are that these will continue. Now, I did speak to one restaurant owner who opted to not go this route of additional prices. But when you look at year over year, those food costs just continuing to increase. And so she told me that we have had to increase our costs more frequently in the last year than ever before. Now, the National Restaurant Association did warn that with these higher costs could come losing customers who simply just cannot afford that sort of luxury.
It's that or we lose more restaurants. We lost hundreds of thousands in the pandemic. Brooke DePalma, good stuff. Thanks so much. Coming up next, we'll speak with the co-founders of Credit Rich about improving your financial literacy. Stick around.
Let's take a quick look at how the Dow, S&P, and Nasdaq closed for the second trading day of June. On this market check is sponsored by Tastyworks, and you're looking at green across the screen when it comes to the Dow, S&P, and Nasdaq. The Nasdaq was today's leader, up just over 2.5%. Taking a look at the sector action that we're seeing, only one sector, energy, ending the day in the red. 10 of the 11 sectors trading to the upside. Leadership by materials, consumer discretionary, communication services, and technology. Those four sectors were among the top performers today. Well, fintech company Credit Rich is making it easier for people who want to improve their financial status and also build credit. The company recently partnering with Visa to create debit and credit cards for millennials, Gen Z, the Black community, and the underbanked. Joining us now are Credit Rich co-founders Angel Rich and Courtney Keene. Angel and Courtney, it's great to have you both. Thanks so much for joining us.
Thank you so much for having us. We're extremely excited to be here with you today.
It's such an important topic. And Angel, let me start with you because the most recent data that I saw from the Consumer Financial Protection Bureau shows that about 45 million adults are considered credit invisible, meaning that they have either no credit score or very, very thin credit files. How does your partnership with Visa and some of your past partnerships help address this massive issue?
Yes, we are thrilled that Visa takes the underserved community very seriously to the point that they have put their money and their heart where their desires are and partnering with us. They have not shied away at all from wanting to work with this community. And we know that our product is going to bring heightened rewards as well as credit expansion that helps them to have overall financial prosperity and ultimately be able to get better credit options.
And Courtney, I was looking at a few more statistics. The U.S. is the largest world economy. We all know that. Yet the Standard & Poor's Global Financial Literacy Survey ranks our country number 14 when measuring the portion of adults who are financially literate. Being financially literate is such a key piece in all of this. Talk to us just about the importance of this and what you guys are doing to educate those who may not be familiar with this right now.
Yes, it's very important, especially when you're going out building your life after college. You buy a house, getting a car, getting loans to start businesses and such. And it's a shame that a lot of people don't understand how credit plays into that and just building up your life and following your dreams. So we're here to teach people about financial literacy, understanding your credit, how to budget properly, just to help you live a better life and go after your dreams.
And Angel, the roles that employers play in all this, because we know employers like to prioritize health, they like to prioritize other benefits. They don't necessarily take financial literacy into consideration. What's the role that they should be playing and could be playing in this?
You are pulling on my heartstrings. When at my former corporate position, I helped them build the wealth management system there. And I felt as though it was critical to have this across the organization for employees. And that was 10 years ago. I am shocked that in today's climate that every organization does not have a wealth management system akin to a health management system. One of the greatest stressors in life is your finances, and it's directly connected. So if you can help people alleviate the pain of that little 3-digit number that sometimes can make or break their life, that can make the difference between them being in an apartment or in a home or their child going off to a college of their choosing, it is essential that these employers offer programs like Credit Rich. And we hope that we can become a great measurement tool with these companies.
And Courtney, what about the mistrust a lot of times in some of these underserved communities when it comes to the larger financial institutions? I guess, to what extent is that contributing to the racial wealth gap that we have in this country? And what can those larger institutions do to rebuild that trust?
Yeah, a lot of that has to do with just the lack of education. And a lot of times minorities look at those with wealth that do not look like them. So as long as we provide them with the knowledge that they need to succeed and get there in life, especially those that they look up to and people that they see in media, this really helps to close that racial wealth gap.
And Angel, I know you graduated college with over $100,000 in debt. So you have your own experience with debt. For people out there who are listening right now, who want to get a better handle on the debt that they have and improve their credit, what's one or two steps that they can do immediately?
Yes, well, that's actually kind of the premise behind our app. Our app allows them to be able to round up their spare change to pay their bills intelligently in the most optimal manner. And we're excited to be in partnership with Visa as well as Experian. So for the first time ever, we have streamlined mobile banking, credit reporting, and online payments in one system. So if you have $180,000 worth of debt and you only have maybe $500 in disposable income, you want to make sure that you are putting those payments towards the debt that is going to have the greatest impact to raising your credit score. So you want to be looking at things like how long the debt has been on your credit, what the length of time is, if it is greater than $10,000, if it is a student loan, if it is a revolving credit item. All of these different things have multiple different impacts. And another thing that our app helps you do that I'll give a tip on is setting a budget for your spending towards the debt that you want to pay off. You should be taking a good 20% of your disposable income and putting that towards paying off your debt and building your credit. And ultimately, even if you have a great credit score, don't just sit on that 750 or that 850. We want to help you become credit rich, because you might only have a capacity of $50,000. We want to get you to maybe $1 million of credit capacity.
I think everyone loves the sound of that. Angel Rich and Courtney Keene, thanks so much for joining us, co-founders of Credit Rich. Well, coming up, Mental Health Awareness Month may be over, but self-care is still top of mind for many. We will discuss with the CEO of Hyperice right after the break.
Mental Health Awareness Month has passed, but more than 100 U.S. companies are keeping the focus on employees' mental health. Hyperice, who makes massage guns, among other products, together with Gatorade, Equinox, PGA Tour, UFC, and others, form the Workplace Alliance. Hyperice CEO Jim Heather here to tell us about that. Jim, it's good to see you. What are you doing to improve mental health in the workplace? And what made you come around to that?
Yeah, thank you for having me on. First off, happy to be here. This was a big initiative for us. We made an acquisition last year in 2021 around Core, which was a mental wellness and breath training device that was very innovative. And over the past 6 to 12 months, as we've seen kind of the post-pandemic era, so to speak, and moving into a new era, we've realized that we could address the workplace in a really meaningful way. There's a lot of anxiety, a lot of stress in the workforce, and we felt like we could make a tangible impact. So we brought on a variety of companies, very progressive companies that joined this initiative. And our plan is to address over 1 million individuals and to measurably impact them by 2024.
And how do you do that?
Yeah, so it's a combination, and we have great partners. You mentioned some of them: Select Medical, Equinox, PGA Tour, Major League Baseball have joined forces. But we start with the device and the technology, and we're actually allowing the workplace environments opportunity to see dashboards around how it's improving mental strength, how it's improving performance, and how we're reducing stress. So the product actually has biosensors built in that measure your heart rate, and it's using an ECG sensor, where we can actually get medical grade data and actually impact the way that somebody is responding to meditation and breath training. So it's never been done before in this capacity, and we've seen unbelievable results.
And beyond the device, are you encouraging mental health activities in the workplace?
Yes. So we're working with each individual company to develop kind of an individual platform for their company. So it starts by the onboarding with their HR executive, whoever it may be, and we address different elements within their company that they think they can improve. So some companies might prioritize mental strength. Others might say, hey, we want to reduce anxiety. Others may say, we really want to improve performance or decrease stress. And it's a combination of things working with them so that we can basically implement something that they feel would be effective for their workplace. And we're also, I think one of the most important initiatives here, or the most important elements, is that we're getting more people to be aware of how impactful this can be and how important it is. And when you think about a company and looking at retention numbers and making sure their workplace populations are feeling good in their environment, they see the impact very, very quickly.
Jim, what's the feedback that you're getting from your employees within Hyperice? You're spending more of the time focusing on mental health. What has that been like, and what are you hearing from your employees?
Yeah, and our company, Hyperice, we were the very first to roll out this workplace platform. So we had, about 150 employees internally go through the platform. We learned a lot from that platform. But I think this was a big move for us. When we made the acquisition in 2021, it was transformational. A lot of people said at that time, hey, Hyperice, you make physical wellness tools. Like you don't have the right to go into mental wellness. And we felt the opposite. We felt like because of our distribution, because of our position in the market as being innovative, that physical health and mental health really were synergetic. And if we could elevate the mental side of things, we could elevate physical. And if we could elevate physical, we could improve mental. So I think it's been received really well with our internal population. A lot of employees have reached out to me personally and said it was one of the most exciting things we've ever done to enter the space in a really meaningful way. And we're just at the beginning of where we really want to go with this.
I think that's a major misconception. Yes, physical and mental health go very much hand in hand. One of the big stressors today, in particular impacting workers' mental health, is return to office. And a lot of people talked about Elon Musk saying, not in my company. If you don't want to return to office, go somewhere else. Why do you think that is stressing out workers so much? And what's your return to office policy?
Yeah, so ours right now, we call it a hybrid, kind of a flexible hybrid remote policy. So right now it's 2 days a week, and we may go to 3 days a week, and there's some flexibility on days that they pick. We do believe that collaboration in office is really important. So we encourage our employees during those days to be more collaborative and to have team meetings and to learn and to teach and to motivate. But we also understand that the flexible environment, especially in a period of time where it's been 2 years since a lot of companies have been back, there needs to be some time for employees to really get comfortable with that change, so to speak. So I think all of these things really play into people have called it the mental health crisis, so to speak. There's just a lot of change in the environment. And that's one of the reasons that what we're doing in the workplace is so imperative and important. And we believe that we're going to learn more about the individual through this platform. This is what we believe to be the largest biometric study, so to speak. We're trying to get 500 companies engaged in the next 120 days. And we're going to learn from this, and we're going to share our data for those companies that want data shared. And hopefully many can learn about what the pandemic has done to individuals, how people are feeling, and how we can dramatically improve stress and anxiety in the workforce.
Jim, just share firsthand what it's been like leading a company like Hyperice through this transition period when we're hearing different feedback from workers. They want more flexibility. You still want to have a strong culture at the core of your company. How have you navigated that?
It's been a challenge. I mean, it's definitely been challenging. Not going to sugarcoat that. I think that you have to, as a CEO or a leader, kind of really identify what you think is important to put the company and the employees in the best place for success. And for us, we do believe strongly, myself and the leadership team, that collaboration is important. Young employees learning from managers, growing in the organization. We've always preached that we want this to be a place where you can grow, learn, and expand your career objectives. And so we do think that that's important. But I think you really have to think about all elements. You have to think about the business needs, the employee needs, and you just have to think about how people are perceiving different decisions you're making a lot more than you used to. Right? Every decision that's made is interpreted in a variety of different ways. So I think we're spending a lot more time making the decisions, return to work, policies, procedures, the way we're positioning mental health than we would 2 to 3 years ago.
All right, Hyperice CEO Jim Heather, appreciate you joining us today. Thank you. The Social Security Board of Trustees has just released their annual report detailing the financial status of U.S. Social Security and Medicare programs. Yahoo Finance senior columnist Carrie Hannon is here to break it down for us. Carrie, good to see you. It's actually good news for a change. Is that correct?
Well, let's say a little bit of good news.
Okay, we'll take it.
The recovery from the pandemic was more robust and faster and stronger than anticipated last year. So what that meant is that there were more people, working, the Social Security taxes were there. So that's good news. So in a sense, they were able to push back 1 year, the short fall that they anticipate coming in the surplus fund for Social Security. But both Social Security and Medicare face really significant long-term financing challenges. With the good news from last year being that, the disability insurance is still going to be there. They see no shortfall there whatsoever. But yes, we have these very serious implications ahead. So, what they're saying is the costs are going to continue to grow faster than the GDP through the mid-2030s. So in essence, we're just a little more than a decade away from the main trust fund being exhausted. So in essence, there's a little more time. We bought ourselves some time because the economy was a bit stronger. But the sound, it's very clear the policymakers have got to make some changes here. They need to act because it takes time for these things to roll out. So reforms need to be put into place. But the people who are so panicked that they're never going to get Social Security are mistaken. In fact, they will still receive Social Security, but we need to make some changes in order to have that surplus.
So, Carrie, that begs the question then, if we don't see changes, I guess then what happens after 2034, after we get to the 2030s? How worried should we potentially be?
Yeah, it's so difficult to know for sure. But the experts I talked to this afternoon were simply saying that, yes, in fact, we really have to get going on something. But the number that everyone throws out is that it'll be around 77% of what the current scheduled amount is. So it's not that it's going away completely. You're not going to get anything, but it will be reduced if something does not get done in order to kind of make some changes here. Because, with an aging population, this is something that is a very real fact that you cannot escape, that there aren't as many people that are going to be in the workplace in order to support that aging population.
All right, Carrie Hannon, thanks as always for hopping on here and joining us. Here's a stock that I am watching tomorrow, Okta, and you can see shares jumping after hours now. The company just reported its first quarter earnings, and the stock up just about 16%. Okta reporting a narrower loss than expected. Sales also beating expectations. The company raising its full-year revenue guidance. Investors clearly liking the news. After hours, trading just around $108 a share. Well, coming up, King James may have missed the NBA playoffs, but he's still taking home a nice prize, a massive payday, a couple of days, you can say, for LeBron James. We're going to be back with more in just 2 minutes.
All right, the NBA Finals are here, and there may be a new owner of the Portland Trailblazers. Nike founder Phil Knight and Los Angeles Dodgers co-owner Alan Smolinski are reportedly putting in an offer to purchase the team for more than $2 billion. Knight's bid has not been finalized, and discussions of the potential sale are ongoing. With Knight's long-standing ties to the state of Oregon between the university and Nike, this could be a sign that the team may stay in Portland, the team currently owned by the trust of Paul Allen. As I mentioned, the NBA Finals between the Celtics and Golden State Warriors tip off tonight. Are you excited?
I'm very excited.
I am thrilled. LeBron James, his Lakers missed the playoffs entirely, but a nice consolation prize for King James. Forbes officially declaring him a billionaire today. Josh Schaefer is more excited about the NBA Finals. Big Celtics fan. He's here with that story. Josh, he's the first active NBA player to achieve billionaire status. He makes $40 million a year, but that doesn't add up to $1 billion. So how'd he do it?
Dave, I got to say first, it's the finals and we're talking about LeBron. It's unbelievable how he does this, isn't it?
Yeah, he's good.
But we'll break it down, right? So LeBron made about $385 million in salary so far. But when you look beyond basketball, that's where the numbers get really interesting. So we have the Spring Hill Company, that's his production company, and that's the one that produced Space Jam and has produced a couple other films, also producing a biopic on LeBron. So Forbes estimates that's about $300 million. Then you have his stake in Fenway Sports Group, that's $90 million. Blaze Pizza, this one's my personal favorite because it's estimated that he invested less than $1 million originally for a 10% stake, and now it's worth $30 million. So that's a huge jump. Then he's got the real estate, $80 million. He's got a couple big properties. And then here's the big bag that we're all sort of wondering, what does that mean? They think he's got about $500 million in cash and different reserves and other things just sort of incoming. It's $800 million.
That can't be true.
It's $800 million before the 500. So he's very close to the billion before the 500.
The cash reserves.
And then it's how much really are the cash reserves? I'm not sure, and you're not sure either.
I'm skeptical.
I think the craziest thing, though, is what we're seeing from athletes, right? Yeah. The way they're investing now. Mm-hmm. We talk about that Blaze investment, and it's pretty famous because the report is that LeBron actually denied a McDonald's sponsorship in order to do the Blaze deal. He wanted equity. And all these athletes are going for these equity deals now. And the question is, who's going to kind of win out on those? And I think there's some fun names we can bring up, the players that kind of make the most money right now in the league. And you see LeBron with a lot of soccer players there. But we know Steph Curry's been very involved with something like FTX. He's been involved with crypto. And then if we go to the next slide, you'll see someone like Kevin Durant, who's involved in Whoop. Patrick Mahomes is also involved in Whoop. Tom Brady, obviously, has built this business empire we talked a lot about when he retired for all of 40 days. Mm-hmm. But you think, if Brady keeps playing and his brands keep growing, it's reported that he might have a stake in FTX too. Maybe he's a billionaire at some point while he's still playing. It really just depends on how these estimates go.
Something TB12 could be worth $1 billion in and of itself at some point.
Right. And you talk about the Brady brand that he's building and those clothes and everything. I think he's a really interesting person to watch. Mahomes is my current player that might get to the current player billionaire status to watch.
He's halfway there with one contract.
10 years, $450 million.
Yeah.
Couple smart investments, and there you go, I guess,
He's closer than we think.
Tiger's a billionaire, we know that.
We know
Active
that.
athlete.
Yep. Been for a while.
Josh, good to see you, my friend. Thank you so much. That will do it for us today. For Shauna Smith, for Josh Schaefer, I'm Dave Briggs. We appreciate you being with us on this Thursday. We'll be back Friday, 3 to 5 Eastern Time, but Yahoo Finance is back 9 a.m. Eastern Time live. We'll see you tomorrow.